1, 2, 3 test. 1, 2, 3 test. Morning, ladies and gentlemen, and welcome to the Risk CEE Summit. Thank you all for connecting to the stream. We are happy to see you all and hope you will find this summit beneficial and interesting. For those that don't know, Risk CEE Summit is a part of our Finance CEE network, a regional association of professionals in corporate finance, treasury, risk, and accounting. To learn more about the network and its activities, please visit our website. Today we will cover 4 modules that consist of both keynote and presentations and the panel discussions. We will open the summit with module number 1, is called Risk Trends, with talks about regional and global trends and risks that corporates are facing. This is a live event, so we encourage everyone to take this opportunity to interact with our speakers throughout the entire summit and to ask questions. Use the chat box to write your questions or comments. We will collect them and address to a speaker accordingly. The recordings of the webinar will be available next week for all registered members of the network. For non-members, the video will be available on demand only after the registration. That's it from me, and let us start the summit with our first module with panel discussion. The perfect storm, risk-rich year, and what to do to live through it. The discussion will be moderated by Alexander Ilkun, independent consultant. Hi, Alexander. Thank you for connecting, and the stage is yours.
Thank you, Dustin, and good morning. Good morning, everyone. It's a pleasure to be here, and a great privilege for us as the panel to be the first one during the day today. That hopefully will be very interesting, and I hope that we will be able to set a positive tone as much as it is possible, talking about risks nowadays. My name is Alexander Ilkin. I come from Latvia, having worked in the treasury field for 12 years. I was employed by G Capital and Moody's in the past. I'm currently a consultant in the treasury risk, technology, and automation fields. In today's panel, as Dustin mentioned, we'll be talking about the risk-rich years, not just 1 year, but we had a number of them very interesting years lately, full of different challenges and risks that we will, some of which we will cover today. And we would like to set the stage by discussing the key risks that are impacting the economies at large, the organizations that the exalted panelists are working at. So what are the key risks that you are seeing at the moment? So Olivia, why don't we start with you? Give a brief introduction, and yeah, would be happy to hear your thoughts on the key risks.
Hi everyone. Can you hear me?
Yes.
Yes. So first of all, welcome from my side as well, and thank you so much for investing the time to be with us today. My name is Livia, like Alexander has introduced. I am a finance and risk management professional with experience close to 2 decades, I would say now, and out of which half I spent in the financial sector in banking, and the other half I went to industry covering pharmaceuticals and agribusiness. Also, I have experience as university lecturer and also supervisory and advisory board experience. Currently, I'm holding a mandate for independent audit committee member of financial institutions from Romania. Now, Alexander, you've mentioned about the positive tone. We will do our best, but let me tell you that if we would have had this event maybe end of 2022, the tone might have been a little bit different, let me put it like that. And for good reasons, I would say, because 2022 have shown us how different shock on economies could layer up. And we are 1 week to the year, to 1 year where the Ukrainian-Russia conflict has started. So we had war at the borders of EU. Also, we have seen very high inflation rates, We have seen raising cost of raw material, energy, pressures on supply chain, challenges in labor market. We have unprecedented risk cost raising of costs in financing, but also volatility in currencies. And to put everything on top, you know, there is also the pressure of going greener with circular economy, with fighting climate change and so on. So in this particular context, I would say that 2022 was a challenging year, and I would have said that if we would have had the discussion in 2022, most probably the tone would have been different. Now, seeing all these shocks, I do believe that economies have navigated so far well. And let me give you some details on how the countries from EU have been. So in Romania, we have ended the last quarter of 2022 with an inflation of 16.37%, which is, of course, two-digit inflation. It's something that we do not like. In other countries of EU, we see Hungary with 25%, we see Latvia and Lithuania with 20%, and a lot of countries that have above 15%, which was something incredible. And in all these conditions, a lot of industries have been differently impacted. And we have seen, like, for example, 50% of increasing construction materials, influencing not only the construction by itself industry, but also like consumers and also companies due to investments. There were a lot of delays in deliveries and so on. Of course, it is something worth mentioning about the gas prices. Gas prices which skyrocketed from 10 euro to 330 euro per megawatt. So it was incredible. And I'm saying this in Romania, this increase in gas, considering that Romania is more or less in a favorable position when it comes to gas because we have internal production. 80% of the consumption, it is based on the local supply. So now the optimistic tone. I would say that in 2023, we see the inflation slowing down. And now we have reached in Romania 15.1, which is less than we expected. According to the Bloomberg, it was 15.8, few percentage down. Also in the same sense, the National Bank of Romania revised the forecast for inflation. So for 2023, we expect to see going below 2 digits, so going down 7% for 2023, and also continuing this trend of decrease, reaching in 2024 to 4.2% in inflation. So although we see this positive trend, I would say that we are well above the target. The target for inflation is 2.5. So things would definitely be challenging. Now, there are a lot of talks on recession, you know, and there is also a positive aspect that although we have seen these overlapping shocks, we have an economic growth of 4.8%, which will continue in 2023, but around 2%. So less.
Great. Great, thank you, Livia. It's yeah, you described a whole host of challenges, especially from the economics perspective. Thank you for that. Marco, why don't we turn to you? What are the key risks that are close to your heart, based on what you are doing?
Hi to everybody. First, I'm Marko Rodic. I'm coming from Serbia. I'm working in banking industry for 15 years. In risk management, in underwriting, and it was in Credit Agricole for quite long period. Now I'm in the Raiffeisen Group. So regarding this, what Livia said, this gives us the basics of perfect storm, which was the key topic, which was in this discussion. But you know, there is a mixture of several negative elements which occurred in the same moment and which the provoke situation as we have now. Regarding underwriting and the banking industry, you know, the key pillars which affecting the client's capacity and the financial strength of the clients can be summarized in the inflation, interest rate, and operational changes. Because, you know, the first 2 points, inflation and interest rates, this is directly linked to weakening the financial strength of the retail clients. Because what is very specific, we had quite long period of very low interest rates, more or less stable economy with some natural oscillations and natural cycles. And in this way, the banks, let's say, don't lose their guard, but they are open to take a little bit more risk because we are all swimming in the calm waters. And then in quite short period, we had the COVID situation, and now we have this situation, what we have now. And this is the significant pressure on the clients. And in this matter, you know, the big companies, they are more resilient to this situation rather than the retail bank markets, the private individuals, the small companies, they are more exposed to these additional financial pressures. And what is very visible at this moment, there is operational changes in the behavior in the market. So there is a change in business organization, there is changes in the supplier chain, logistic chain, way of organization of the transport. There is even change in the behavior of the consumers. We have quite specific situation here. Serbia is one of the big exporters of strawberries, and there is a significant drop in demand in the first quarter or in current months, expected for the first quarter as well, because the strawberries become something which is expensive and not a priority at the list of the consumer needs. So this is something which gives us important signal what is the size of the pressure of the budget of each individual, which we have here on one side, and what is this pressure resulted in the change of their behavior. So this is something which we are living now, and this is something to which we need to adapt. So from my point of view, these are the 3 points which are now giving quite visible effect in current economy.
Great, thank you, Marco. So we moved from the economic shocks and inflation to the interest rates rising, right? And we are seeing how this is impacting, and how the whole situation is impacting not only the business models but also personal spend. Yeah, thank you for that insight. Elmar, why don't we turn to you? Please introduce yourself, and yeah, what are the risks that you see that come to your mind?
Good morning, ladies and gentlemen. I'm very happy to be here. I have been working in the banking since 20 years already. So I started at HVB Bank, which was a daughter company of HVB Bank back in 2022, working there in transformation projects, integration projects of banks, mostly in controlling and accounting divisions in that period. Then I moved to Bosna Bank International, and I've been here for 14 years already, which is Bosna Bank International is a mid-sized bank in the country, and has seen a substantial growth in the past period. I was also engaged as a lecturer at the university and do some research, mostly in the area of ESG segment. So we have heard Marco and Livia talking about different risks that we have been exposed to. And I would just like to recall to the start of a Corona crisis. In that period, all consultants, all large auditing companies were predicting huge growth of non-performing loans in the banking sector. They were all projecting huge recessions and so on. And really, we have seen a huge recession, and certain segments of economy were hardly hit. However, if we look at the overall market, what can be concluded is that all these markets have actually seen, due to state measures that were taken, but really heavy state measures, we have seen actually an improvement of the quality of portfolios. We have also, if we look at the current in the past year, we have a big war going on in Europe. However, this is not reflected in the balance sheet of the banking sector, at least not in Southeast Europe. As we are not directly exposed to the war, we are exposed to macroeconomic environment changes, but this has not impacted this. So far, we have seen improvement of both S3 portfolios, which are non-quality loans, and S2 portfolios, which are portfolios with increased risk. So besides that, interest rate environment, where we see an increase in interest rates on loan portfolio, it has actually positively affected the profits of the banking sector. On the one side, we see the increase of loan prices, but deposit prices are not following this. Most deposit products, at least in Bosnia, are not directly linked to Euribor. So currently, banks are actually having buffers for the future period. However, it must be noted that we all recall the large international crisis in 2008. In Bosnia, we have seen the increase of and deterioration of the portfolio quality 2 years after the start of the crisis. So I'm afraid that we could see the results not even in 2023, but in 2024, because everything comes with a huge time lag. And the future will depend on how actually those conflicts are being resolved. We have seen large disruptions in supply chains, which negatively affected Western Europe producers. On the other hand, we have seen also a trend of moving production from Asia to Central and Eastern Europe, which is a chance for Central and Eastern Europe to develop even more than in the past. So in Chinese, chance is a crisis. So I think we all have to look at all what is going on from positive side, and with that in mind, I will close my session, current session.
Great. Thank you, Elma. Thank you for the insights you offered. Our fourth panelist, last but not least, Algimantas, can you please also introduce yourself and add to the plethora of things that we see at the moment?
Yeah, hello, pleasure and honor to be here. I am Algimantas Gaulė, Chief Risk Officer at Šiaulių Bankas, Lithuanian bank, and I work for the banking sector also over 20 years. And this year there will be 10-year anniversary for me in Šiaulių Bankas. So I have gone through and seen much developments, but developments that happened in the recent years, I would call them unprecedented. But then again, I have some optimism to share, and probably I would touch upon the disruption of key markets caused by the war that broke out last year, and impact to the creditworthiness of the customers. As you know, Lithuania happens to share the border with one country that is directly involved in the war, Russia, and also Belarus, which is also not directly participating, but indirectly participates in the war. And as due to such geographical circumstances, there are businesses that have ties with these countries. So when the war broke out, we reviewed our customers that had sales, supply, or ownership ties with Russia, Belarus, and Ukraine. It's not a significant part of our balance sheet, 5%, less than 5% of the loans, but still an important for us segment. So basically, what we found that our customers are very resilient, and we tend not to put all the eggs in one basket. So the initial assessment just after the war broke out, with all of uncertainty ahead and etc., we showed that for most of these companies we do not need to worry, as we have quite diversified sources of income or of supply. So but of course, being careful, we put some companies into watch list, stage 2, so that we could monitor their performance more. And we saw their plans that we were intending to either get their materials from other countries or find new export partners. And actually, we were very surprised by how well we managed to execute their plans. If we look at the default, so it's one-off idiosyncratic events of smaller companies who, let's say, were not having any diversity in their business. But if the company had various partners, so we managed to change their either chains or sales or supply chains, and actually lived through with very good. So that's a bit of the optimism that I wanted to share, and it's reflected in Lithuanian economic growth figures, which had to be revised upwards through the course of the year. So that's
great. Thank you, Algimantas. And yeah, just going back to what I said about positive tone. It seems like going through the risks that overlap each other, we probably hit the lowest point in positivity at the moment. So let's try to get back up with positivity as we discuss the other questions. And one of the things that comes to mind is really adaptability, adapting to these challenges, and how the different companies and organizations, economies are actually doing that. So I think Livia, maybe I would ask you to opine on this question coming from Bayer, right, and taking into account the pandemic that happened. So wanted to hear from you, your opinion on adaptability. How do you see companies adapting in this challenging and it seems unprecedented environment where so many things overlap?
Definitely unprecedented. But you know, whenever there are challenges, there are also opportunities. And during these challenging times, I saw a lot of organization, Bayer included, that is working on reinventing themselves. And you can reinvent yourself when you are tackling, when you have a holistic approach. And organization in general, they are looking into 3 directions, you know, reassessing their revenue streams, reassessing their cost streams. And very, very important in these uncertain times is cash management, cash flow, and diversity of financing sources. Now, Elmar was also mentioning about some switch in production due to, you know, China situation. But I would also say that the war have created also some other opportunities. Like we know that Ukraine was the #1 exporter in sunflower seeds and oil. So this part of activity should have moved somewhere because the demand was there. The demand was not gone. So this was brought into EU as a new revenue streams. But also the pandemic has shown us that it's more and more important to be present in digital environment. And we saw not only with our industry, but going a lot in e-commerce and really reinventing companies themselves, like opening, we saw in Romania a big e-commerce chain opening a supermarket, an online supermarket, so really going out of their comfort zone in implementing some new areas. So we see this going on around. From the cost perspective, of course, there are some opportunities coming from the new way of working. We've seen a lot of companies that are trying to reduce the cost, and really an easy subject would be with the office spaces, considering that we have the hybrid mode. And from the cash management perspective, of course, it was important. It's even more important now to have liquidity. And considering this type of increase in prices, when we see loans like 10%, but you have a business with a profitability of 3 to 4%, so you really need to find the right balance in finding sources. And I think that here it's a challenge. However, it can be done with a close collaboration between suppliers, customers, and banks, I would say.
Right. Great. Thank you very much for sharing these highlights. Argument is you mentioned the geographical position, right, of Lithuania, or indeed the Baltic states, right, and the reliance that the companies here have on the ties with our neighbors, right? So how do you, where it comes to this just geographical position, right? How do you see companies that do have ties with Belarus, Russia, overcoming this and adapting to this new environment? How do you see them surviving in this in these conditions?
So I would say that it is maybe a historical issue, as well as with war is not the first time that the trading ties have broke. So there was a Russian crisis before, and also when 2014 events broke out, EU sanctions happened. Also, there were some breaking of trading ties. So I would say that our companies got used to it. Those who still chose to work with these countries, we understood that it is high risk and high reward activity, and we left themselves a path ahead, and also as the reorientations had to be done before, so we have the expertise for reorienting the business, which helps in such cases when you need to go to find new suppliers or new markets to export your goods in. Then you can do it when you do something for the second or third time, you do it better than for the first time.
Right. That is a great thought, and I think it also chimes with another theme, right? So you can adapt to the environment, but you also have to be operationally resilient, right? So so that you know what do you do in these unprecedented situations. You plan for your business to continue, right? And you essentially try to survive no matter what comes. And I think I would probably suggest to speak a little bit about that, the operational resilience of different different companies. So I'm wondering, Elmar, what strategies do you see companies implement in order to survive in this environment operationally?
Mm-hmm. Well, I'm going to talk from the banking sector perspective. What I see is actually a big challenge for all institutions, no matter how advanced new technological developments are, is the fact that all of them are relying on many different solutions, and there is a huge time consumption in reconciling all that data coming from different sources, and on the other hand, fighting to improve and offer better products for clients on the other side. So no matter where, was it for example in Germany or as the most developed country, or Bosnia, which is for instance a country in developing, there is always a fight with data quality management, and the challenge to actually to get the right data on the right time in order to be able to do high quality analysis needed for management purposes and risk management. So it's amazing actually how, despite all different kinds of solutions available in the market, we are really continue to fight with just basic data and data quality and different systems and reconciliations and so on.
Right. Yeah, that is great. That is great to hear. And and you're right. I think yes, of course, the situation is unprecedented, right? But we also have the various tools available to us, right? The insights from data that we can gather to really extract the best that is possible given the circumstances. And of course, depending on the organization, the challenges and opportunities will be different, right? But hey, everyone is trying to do their best. And access to tools, technology, and data nowadays is very important. So thank you for mentioning that.
Yes, and today we will have a additional panel which is called a risk data panel at the end of the day. So in that panel, I will actually refer more to data quality and policy and validation systems. So stay with us.
Yes, absolutely. Marco, why don't we turn to you? Would be very keen to hear your thoughts on operational resilience of organizations.
Well, you know, situation is specific. We had three different impacts which are here mentioned and which are visible in the changing behavior of the companies. First of all, we had a COVID situation when generally it was one type of the problem for the companies. In the general situation is that the global market didn't have any economical constraints. There was a health issue, there was operational issue, but market, there was no political, not economical barriers. And in this matter, the companies start to adapt. But this modification of their business was more operational, linked to the more online meeting, more reorganization of the transport, diversification of the buyers, etc., etc. But it was linked with the fact that they need to make operational changes to existing business with possible upgrades. Some companies use it well, some didn't. So they had some slowdown, but we are evident that from COVID situation, some companies use this and make their business better. On the other side, as Livia mentioned, the Russia-Ukrainian situation make the problem globally with the business of the companies. It's not more the operational organization, but it's more core business. There is a problem. You stayed without key partner. You stayed without key supplier, without strategic input. There is a problem regarding the what Aligmantas mentioned regarding the ownership structure. There is a lot of issues which are not more operational. They are business. You need to find the other inputs. You need to find other buyers, suppliers. So there is a need for the business change, which is quite difficult at the moment when you have a crisis on the other side, because you know the market is lower and you need to make the strategic changes. And the third point, which is let's say I hope the last one, it is the financial impact. We have the what we mentioned at the beginning, inflation, we have interest rates, we have the energy issues. So all this affect pressuring the balance sheets of the companies. So in this manner, the companies cannot so easy adapt. So they need to make the financial modification of their business, and it is visible. They are postponing investments, they are recalculating the costs, they are recalculating the margins, they are keeping the liquidity reserves. There is the intervention of the governments in order to prevent the liquidity, in order to keep the liquidity of the companies. So this third element comes at the end. So we had first operational changes, then we have a business changes, and now we have the financial impact which companies need to adapt. The problem with this financial part is that is evidently postponing the investments, because the management of the companies want to be careful. It's time for them to be careful, it's evident, and this make the spiral to go deeper down. So we hope that this situation is will be soon finished. So Olivia mentioned that there is a positive side regarding the inflation. You mentioned that, I believe, the example of your UK, that there is more interest to look the floating interest rates, expecting that they will decrease in the future. So we will see what will happen, but you know, we need a little bit push. Economy need to be pushed a little bit, supported more, because now the management give the really good defensive strategy within their company. They really make the good basis for further development. And now when we face this even spot of light, the companies will be very strong to have a very fast recovery in very short period. Of course, we cannot forget that even in this situation, there is a companies will find open doors to make the new business, to make the new contracts, new partners, and to improve their margins, because now that the market is in big discrepancy, in big disruption, there is a lot of changes, and the skill management and skill company can use this, and we have a lot of examples which use this current situation to develop their business.
Right. So it sounds like the companies are actually looking at crises as something like business as usual, right? We've seen the pandemic where companies needed to adapt and improve on their operational resilience, the tools that they're using, right? The new challenge comes, and then, hey, we enact the crisis mode again, we try to figure it out. Then the next wave comes, interest rates go up, right? The financial impact. So it goes on and on and on. So it kind of becomes ingrained in the nature of what the companies do.
Well, if you observe like this, if the business go good and everything develops, then you have a new crisis because you are exposed to very strong competition, you know. So
right.
there is always the pressure, but there is always the crisis, but depends what is its origin and what are the effects. So some can be positively observed and some not so positive.
Right. I am wondering, so we were talking about the companies doing something on their own, right? And trying to either adapt or build their resilience. I'm wondering if we see products appear in the financial markets to support those companies, new or re-emerging financial products or instruments that are again getting the attention. So Elma, would you be able to just share a little bit of thoughts on this area? What do you see happening in the financial market space?
So what I notice in generally in Western Balkans is currently the fact is that energy transition is actually lagging behind the Western and Central Europe. So there is a huge demand for new financing in this segment, wind and solar power plants. And on the other hand, we see all those new developers coming, and banks are learning to assess those risks. So there is actually a huge pressure on banks in terms of learning what actually energy transition means, and learn how to assess those projects. So first, there is a risk of assessing the projects correctly, and on the other hand, there is a risk of all those new developers coming in the market and with no prior experience. Well, we do have some even large companies coming, but they're not able to cover the whole market. So, but banks in general, they do not have developed products yet that will cover this need. There is a huge demand alone in Bosnia. It is expected that at least 8 billion euros are going to need to invest it in the next up to 2030 in order to cover and to support energy transition. So that segment is definitely on the one hand a chance, but also a risk of for banks to be able to understand it. And actually this is going to mean a big change, not only for energy related companies, but for all companies that are currently based on fossil fuels. There is a huge impact on all economies in Western Balkans is going to be on the 1st of January 2026, when carbon adjusted mechanism is going to be introduced, which is going to introduce taxes on all products that are exported to European Union and refer to aluminium, cement, energy, and steel, iron as well. So I think that these risks are not recognized yet properly neither by the banks nor by the companies, and that they will need huge things to do in order to adopt their business models and to continue to exist.
Right. No, that is great. Thank you for highlighting this. I think we are so much focused on the present, right? That, hey, what are the risks that are out there now? That the two words climate crisis kind of went a little bit on a side, right? But it is from the long-term risks. This is one thing that is out there, right? That is important to think about and try to do something about sooner rather than later, right? So it's it's great that you highlight this as well. Argumentus, what do you say? From the financial instrument standpoint, the availability of financial instruments to companies or market participants? Is there any trends that you see emerging from your perspective?
So from my perspective, I would like to touch upon a financial instrument that is available to households, because households are also affected by the situation, and I think that all of the main economy starts from the households. So in Lithuania, we have pretty high stock of non-renovated Soviet-built multi-apartment buildings, which are energy inefficient, and given the rising energy prices, this gives additional headaches to those who live in such houses. So our bank is actively participating in multi-apartment housing renovation programs, and we are the leader in our country by issuing housing renovation loans in cooperation with state agencies. There are various schemes, even involving securitizations. But basically, the overall result is that if a multi-apartment house qualifies for energy certificate B plus or above after the renovation, then it can get a renovation loan at very privileged terms, and this is something that I think that everyone benefits from, as the households have lower utilities to pay. The overall CO2 emissions are being reduced because better energy certificates means that lower amounts needed to heat the building, and the banks also earn from it. So that's the situation where everybody wins.
Yeah, that's great. I think this is where I can link it up to what Elma said about energy transition. You're linking it up with the households, right? We were kind of lucky that winter this year was as warm as it was. It gives us extra time, right? And if there is silver lining, an opportunity out of all of it is that, hey, because the gas prices, or in general the energy resource prices, are so much higher, we are all looking at opportunities to do better, right? And hopefully, as a result, the solar panel, the energy efficiency improvements, etc., they will actually help us to deal with the other issue, the climate crisis, right? Reducing the CO2 emissions and other harmful emissions to the atmosphere. Thank you for linking that up. Livia, I would turn to the next question, and there is a question that came from websites that could be linked to that as well. So the question is, can you share what are the key factors you look at when assessing the impact of market disruptions at the moment? And do you feel that we have sufficient technological tools to look at those key factors? That would be kind of a second question from my side.
So whenever we are speaking about market disruption, of course, we are looking about what is happening in our sector from many points of view, meaning that we have sufficient demand, that we are connected related to the regulations, so we could have disruption also coming from regulations, really connected with having sufficient funds for doing that business and so on. And of course, always there is a need for IT tools. And here, you know, it's very much fun to implement from own initiative tools, and it's less much fun when it comes as a requirement of the regulators, like from the tax point of view with very detailed declaration that needs to be submitted. I would just mention the direction of tools, digital tools that are now, I see that now are taking more market share, let's put it like that, and is going into the predictability, like predictability on transfer pricing. So I see these kind of tools being implemented, and through this also we are following very closely the connection with the market disruptions, and so on and so forth.
Right. That is great. Thank you for sharing that. As we are nearing the end of the panel discussion, I wanted to ask a more forward-looking question, right? And really ask you, hey, in a 1 minute kind of short sentence, what do you expect from the future? What does the future holds for us? Marco, let's probably start with you.
Well, the current situation will finish, and there will be just one, let's say, regular economical cycles. When we observe this after a couple of years, so we will say, okay, this is the regular cyclical movement of the economy, and you know, there is, after the rain there is always the sun. So if the economy go down, and the next phase is that the economy need to go up. So we are expecting to see the moment when the economy will go up, and I hope that it will start tomorrow.
Great, thank you for the positivity. Finally, we get the injection of it. Thank you. Elmar, what are your thoughts of what does the future hold for us?
Well, you know, coming from risk segment, I'm afraid, you know, that so far, at least not in the Bosnian market, for instance, if we look at the prices of loans and the loans, we don't see that risk premiums are really reflected there directly. So I'm not that optimistic about the future as Marco. I think that current economic benchmarks are not really reflecting the reality. So we will certainly see some turbulences in future that will result from all those happenings in the past. And all that will depend actually on what happened at the end with the war in Ukraine and Russia, you know.
Yeah.
So, but on the other hand, you know, we are all adapting to it, and we all find ways through it. So,
yeah. I suppose as risk managers, it is ingrained that we look at, hey, what is the worst that can happen, right? And you plan for it. So there is no, there is not as much ingrained optimism that is there in our profession, so to say. Livia, what do you think about the future? How do you look at it?
You know, Alexandra, I'm turning to what you said earlier, crisis business as usual. I wrote it down because this is something very, it stick to my mind. And I would say that definitely we are living through a routine of uncertainty. So this is for sure. But from my perspective, I'm reserved optimistic due to the fact that I know that companies that are thriving to be agile and also putting a lot of importance on keeping employees motivated and empowered, I would say that they have more chances of thriving in this kind of conditions.
Right. Yes. The empowerment, especially with the remote working, right, and an engagement across the globe. Yes, that's an enabler these days. Argumentus.
If we do the back testing of the projections that were made for the last 3 years, we would see that most of these projections have failed. So I think that very few organizations have predicted the COVID and even full-scale Russian invasion on Ukraine, despite there were some signals, but very few expected it to be such a large scale. So I refrain from making forecasts, but I see that ability to adapt is one of the key features for the future success. So that's all.
Right.
Have it.
That's great. Look, thank you so much for sharing your thoughts today. There are a couple of clear themes that come across in our discussion. So we touched on adaptability of companies, households, organizations, economies, governments, right? So adaptability is key in these circumstances. We also talked about operational resilience, right? How it's important to build that, have the plan in place. What would you do if something wrong happens? And hey, we had a lot of learning experience in the last couple of years to put such plans in place and execute on them. right? So that the matter of survival, of course, is at the forefront of everyone's minds. And one other thing that we touched is technology advancements, right? So the tools are appearing, technology is advancing, giving us the ability to really tackle these situations as they are being thrown at us by life. So this also fills me with excitement and hope that hey, no matter what, we are able to look through that, and we are able to model what is going to happen in the future. And all of these themes, so for the audience, all of these themes will come up in the later keynote presentations, as well as the panel discussions. So absolutely stay tuned for more to come, right? So I would turn to to another question that came on the website, and that is targeted towards the energy crisis that affects mostly the SMEs, as well as the lower and middle class households, or lower and middle income households. Do you have any suggestions of financial instruments, or in general, how to tackle this situation, how to mitigate energy-related risks for those individuals or households, as well as the companies with probably less resources than some of the larger? Anyone would like to? Elma?
So, yeah, I can maybe start with where, for example, at least from the perspective of the Western Balkans region, but also the whole Europe. You know, there is the Green Plan of the European Union, which is actually planning to invest huge amounts, but not only as investment, but as grants in order to support energy transition. So all companies should be looking very hard at preparing projects for energy transition, and for sure they will be able to finance them partly also by grants from the European Union, as huge amounts will be available, and they are functioning on a first come first serve basis. So the quicker they are in preparation of projects, the money will be sooner there.
Right, and I suppose, would you agree? It doesn't really matter how big or small the initiative is, right? If it's impactful for the SME, for the household, take a look at it, give it a go, right? Because as you say, there is money available for the green energy transition, moving away from fossil fuels, right? So this is an opportunity that there is out there. Thank you for mentioning that. Anyone else has thoughts on this question?
Maybe I can add just one comment. So the Russia and Ukrainian situation affects the economy globally, and whenever it finishes, we hope very soon, it will provoke the significant changes in the global economy. It will provoke the significant change in the market behavior, and it will provoke the change. It will affect the policy global regarding the resources, including the energy resources. So what we start to see here is that this energy crisis which we have push people to think more about the renewable, which is some positive element. And if we can use this momentum that people now thinking more about the energy, and to transfer this need for improvement regarding the renewable energy, combined with the possible support which Elma mentioned, this could give the good result for everybody.
Right. Yeah, and I suppose where it comes to renewables, on one side there is support from the various governments, right, in introducing those, and on another side, yes, while it requires some resources from the individual's perspective as well as the companies implementing them, the prices for such solutions, for example, solar panels, have come down, right? So so they have become much more accessible, right? So yeah, this is something that could also present an opportunity out there.
From the household perspective, Algimantas told us about the huge demand in Lithuania. Unfortunately, you know, we don't see that in this area in Southeast Europe yet, because people are not aware of that. In Bosnia alone, there is a 5 billion euro, it is 2.5 billion potential for future investments in energy efficiency. But the problem is that people are still not aware of that. You know, they're not aware of how much energy and money they would save by just changing their windows or by improving the facade of their houses and so on. But I'm sure that this is something that is going to come, that will follow in the future period, and that's the segment where huge demand is going to be.
Yeah, and this is where I would probably echo the sentiment from Marco. Hey, we hope that the economy will improve, because of course it's difficult, especially just relating to that question, right? Especially for lower or middle income households to find money when the prices are going up on everything, right? Find the money to seek out those improvements. But the hope is that, hey, as we start going back up, there will be more resources to do even small incremental changes, right? So that the prices, say energy bills for the households, go down, because hey, you now consume less of energy for heating, for example, right? So there is hope that when the prices go so up, people of various incomes just say, hey, can't tolerate it anymore. The government say, hey, we do need to support those who are in need because they can't do it themselves. So there is hope that also the awareness will rise through various programs in all parts of the world. All right. Any parting thoughts? Then I think from my perspective, let me just once again thank you all for your participation in the panel. It was a great discussion. Hopefully, this is a sentiment that the audience also shares, and I look forward with excitement towards the other discussions, other presentations that will be happening throughout the day. There is more to see there, and again, we covered so many key risks. Kind of, I hope we hit the bottom of the pessimism, and the only way is up. The same way as we hope for the economy. So let's fingers crossed for that. But thank you very much for being with us on this panel. Livia, Marco, Algimantas, Elma, thank you so much for your insights and the thoughts that you shared. It was absolute pleasure and a privilege to be here with you today.
Thank you as well.
Thank you.
Thank you.
Thanks a lot.
Thank you very much, and have a nice day.
Have a great one too.
I would like to thank all the panelists for this fruitful and relevant discussion. Thank you, everybody.
Thank you for the organization.
So our next speaker is Tudor Baengiu. He's a director of risk management at BCR Romania, with the presentation which is called Using Risk Taxonomy for Risk Materiality Assessment. Hi, Tudor. Hi, Tudor, are you here?
Yes, now I think. Do you hear me?
Yeah.
Because my Michael was mute and I couldn't start it. Was stopped by you, I think. Okay, and now also you see me. I'm on the camera. Okay, I will start introducing myself if it's
Yes,
okay
from this
your
moment,
side.
the stage is yours, Tudor.
Okay, I am risk director in BCR Housing. It's part of BCR Group, which is part of Erste Group. Previously, I worked in the National Bank of Romania. The most part of my activity in the National Bank was on supervision, banking supervision, and a supervisor. Also, I work in the market operation for 1 year, and before working in the National Bank, I worked in the Ministry of Public Finance in Romania for 1 year and a half. I will start my presentation. This presentation is how to use risk taxonomy for risk materiality assessment. I consider that risk taxonomy is the base for all what we are doing in the risk management, because risk taxonomy is how we define all the risks that are part of our activity. And the presentation is more like what is the result of using the risk taxonomy. So you can see on the, I will share my presentation with you. So you can confirm if you are seeing the presentation. This taxonomy is using the end to being the base of the ICAP framework. The first step in using the taxonomy is risk materiality assessment.
Sorry for interrupting, Tudor. Please, could you go widescreen, full screen?
Widescreen. Okay. Full screen, you said. Okay, full screen. So this taxonomy is used to define all the drivers and the risks that are part of the bank risk materiality assessment. I will show you also how we are doing the risk materiality assessment, but now I will stay at the framework level. So risk taxonomy is also the base for the risk appetite statement, because in the risk appetite statement we have some indicators that have their own definitions, and this risk taxonomy in our group, it's part of a policy called ICAP policy. It's an appendix where all the risk and sub-risks are defined. So as part of the ICAP framework, risk taxonomy mainly impact the risk materiality assessment, the risk appetite, also the risk strategy, and all the others, but more or less. You can see that the main parts of the strategy, the risk strategy, are the risk appetite and the risk materiality assessment. The risk appetite is usually based on what the regulator is providing to a bank based on an annual inspection. They are submitting us the SREP ratio, which is a regulatory ratio that the bank has to comply with. This ratio is after that translated to supporting metrics, limits, and so on, which are also impacting the risk materiality assessment. There are a lot of drivers, indicators that are part of the risk materiality assessment. You can see here the result of our risk materiality assessment for last year. This is only a picture of the final results, where you can see the main risk. In our case, there is credit risk, market risk, operational risk, liquidity risk, transversal risks, and other risks. Other risks like strategic risk, reputational, compliance risk. insurance risk, but I will show you how we are doing this, but at the end. So you can see we have to define, based on the risk materiality assessment, we are defining the risk profile of the bank. So you can see from a few years ago, in our case, the risk profile is high. And this is mainly not from the credit risk perspective, because we have a low portfolio and we are not very diversified, but we are high due to operational risk, because in our case, we have a litigation with the Romanian state, and due to this, the operational risk is at high level, and because legal risk is usually part of the operational risk. I'll go further. This is how the appetite is designed. Based, you can see here the SREP ratio in the first column. We receive from the National Bank the SREP ratio every year. We add it to the regulatory 8%, and we have also the combined capital buffer, so combined buffer requirements. And after that, we have the red level for risk appetite for solvency. And this is derived after that to all our indicators. Also, you can see here how we are building the risk appetite based on, it's written here, this SREP ratio received from the National Bank. Also, starting this year, we have an MBR order which imposed us to use also the counter-cyclical buffer, 0.5 counter-cyclical buffer. We have also for the recovery and resolution part the MREL targets, which is similar to the way the SREP ratio is calculated, but in our case, there is a lag of 1 year between the SREP ratio and the MREL ratio, how they are calculated by the National Bank, because are two divisions with different responsibility, and MREL ratio is not only approved by the National Bank, have to go to resolution committee where this ratio is approved, and it's a lag of around 6 months between the approval of the two ratios. So they are using the ratio, the SREP ratio from the previous year in case of MREL for solvency reasons. And here you can see also the supporting metrics. But I said that these are derived from usually from the SREP ratio. How we are splitting the capital which results from the SREP ratio to different risks, usually credit risk, market risk, and operational risk, because these are the most important risks in the bank activity, and spreading this by using some allocation keys. And after that, we are based on the capital for each risk, we are calculating exact the limits, but these are not shown here because they are specific to our bank. And in this slide, I only use the ratio that are regulatory in our activity. I will stop sharing this one, and I will go to how we are computing the risk appetite. I think this will be more interesting for you. And now good. Okay, can you confirm that you are seeing an Excel? Yes, here
yes,
is how we are. Okay, here it's how we are computing. I'll show you in the first part what is in that presentation. Here is the result of that is put in the presentation, and here it's how we are computing that score. The score for each year is the result for the assessment of that of the previous year end, is how we are assessed 2021 score, which is a real score, the score based on the real indicators that are sent to the regulator. Okay, and this is outlook for the next year. The outlook is based on the budget and the forecast of the bank. And in the end, we have the result for our profile for the year we are constructing the risk strategy. So this was our the result of our risk profile for 2022, which was made in March 2022. So the result is for the end of the year, and you can see here what are the risks that are composing our profile, are part of our risk materiality assessment. This is the way the economic capital it's split on each risk based on also on how we are having the pillar 2 allocation for capital. And based on this, there are formula that we are calculating the final score. And you can see that we are using max because this was a recommendation of our regulator for each risk in part to use the maximum note that is given for one risk. So as you can see, for credit risk, the highest mark was for residual risk 2.5. So the credit risk final mark is 2.5 and so on. How we are computing this risk mark for each risk or sub-risk or driver, I will show you here. The most important is to understand the instructions. We are starting, we have marks from irrelevant, low, low to medium, medium, medium to high, and high for each driver. This is how the final results could be, because we have less areas for the final result and more for the initial assessment. And this is an example. You can see here for solvency how we predefine these levels of risk, low, medium, and high. And these are the finals one, and how we compute it based on an assessment, a comment, which is the final mark, the final value of the indicator sent to the regulator. We are writing a comment describing the actual situation of the bank and what the budget or the forecast will look in our perspective. And then we are giving a mark for that situation, the situation of closed year, and how we are seeing the forecast. And here is the final mark. So, and where each driver has a weight in his sub-risk or risk. And that's how we are building our risk materiality assessment. For each driver, we are describing a level of the level of the risk. We are putting a comment describing the actual situation of that driver or that indicator. As you can see, there are some of them are qualitative and some of them are quantitative indicators. Some of them are effective ratios like risk return ratio, EBA ratio for NP for non-performing exposure, or NP coverage ratio. These are quantitative, only quantitative, and we are putting here the results or of the indicator. Based on the results and of how we describe the level of the risk. We are putting the mark here, the final note. We are also, based on expert opinion or based on forecast, we are putting the notes or the score for outlook, as you can see. And then we are having the direction, how the risk is. Most of them, as you can see, were flat, were constant, but there are also risks that I'll try to find. Okay, to find some risks that move from one year to another. So it's the pillar DOI credit risk capital, which was better the outlook than the initial result, or so from low, I think it became irrelevant. And we having the final score, the weight, and then the final score for that sub risk. That sub risk is general credit risk, and so on. We are building our risk materiality assessment. Let's try to find also some qualitative indicators to understand better how this is made. I'll try to find one that is purely qualitative. It's economic outlook. So economic outlook, more like an expectation of the chief economist of the bank, what the market is and will be. Also, we have a column that you cannot see here, where we have the allocation for each owner, the responsibility to provide the input, comment, and mark for each risk driver. It's an exercise that we are starting around end of February, and it's finished at the end of March, beginning of April, because we have to submit our annual risk strategy to the National Bank until the end of April, and should be approved by the bank management board, and also because we have two levels of supervision at the bank, two levels of management. We have also management board and supervisory board. In our case, should be approved also by the supervisory board, the risk strategy, and these are part, risk materiality assessment and risk appetite are part of the package that we are sending to the regulator and that have to be approved by our supervisory board. We have also some of these drivers are specific to our group, and in that case, these are, as you can see, are irrelevant for our activity. We have zero, the market zero in our case. We are not using that BCR housing level market model risk, because our portfolio from this perspective is not diversified. We even have a fixed position, very low FX position, and that is due to the fact that we have some insurance contract that have to pay in euro. So that is the single perspective that we are having euro in our portfolio, but so the position is irrelevant. We are having some drivers called also model. It's also irrelevant in our case, but being a housing bank, Also, we have some drivers that are specific to our activity and that are not part of our group risk materiality assessment. It's a very comprehensive exercise, as I said, involves a lot of the division from the bank. Also, there are involved division from our group, from BCR group, because some of the indicators are specific to our group and have impact at the group level, not only at BCR housing level. And we have to take the mark that they are giving. So some specific indicators are group level are, as I can see, pandemic risk, which was an important risk in the past 2 or 3 years. Now this will become less important. I think for the beginning, at the beginning of last year, this was a medium risk, and 1 year prior, I think this was high, as I could say, was 3.6, which was high. And starting from the beginning of last year was medium risk. I think now will get even lower. Also, we have ESG risk, but from our perspective, from the BCR housing, this is not relevant. We have only from the logistic point of view, impact from ESG risk from the portfolio side is not relevant for us. And I think I present you the entire way we are doing the risk materiality assessment, and you can see how important it is to have a risk taxonomy where you can define all the risk you are analyzing and all the sub-risk you are analyzing, and our risk taxonomy should be in line with the regulator requirements and also with what our group is using as definitions for each risk. We have to comply with these requirements when we are building our risk taxonomy, and then how this is cascaded to the risk materiality assessment and the final in our risk strategy. So I think from my point of view, this is all I had to present, and if you have questions, I can stop, share this Excel and come back to the presentation, or we are staying on the Excel if someone has question.
Thank you, Tudor. We have a question from the audience. What are the minimum standards for ICAP that are applicable to the bank?
Applicable to the bank. For BCR housing, we have not so diversified ICAP framework. We have stress test. I could go back to the presentation because here it's more relevant to see what it's important for. Okay, share. And for BCR housing, it's important to have mainly the risk strategy, the risk appetite, the stress testing, the risk materiality, the risk bearing capacity, but part of them are not so developed as at the BCR group level. BCR was when I came into the group in 2014, was the first bank in the Romanian banking sector. Now is the second one, and the top 3 have some OSI requirements, other important systemic institution, not only top 3, top 9 or top 10 in Romania. But BCR housing, it's I think for end of 2022 was the second from the bottom. So we have low requirements. As you can see on slide, on this slide with ICAP framework, we have reduced proportionality for our subsidiaries. So we have to follow minimum standards, which are representing to have the risk appetite, the risk materiality assessment, supporting metrics, but also we have regulatory requirements that impose us to have a stress test or exercise and so on.
Thank you, Tudor, for this presentation. Please stop sharing the screen.
Okay.
Thank you for this relevant and very interesting presentation. So, dear viewers, now we are going to have a short break. And after that, we will have a module called Risk Resilience. We'll be back at 10:50. Enjoy the break and see you all soon. and we are back with module number 2 titled Risk Resilience, which tells us how the role of risk manager has evolved in last decade and what skills risk teams need to acquire in order to prepare for the future. First session is a panel discussion called Managing Risk in Today's Volatile Risk Environment. The discussion will be moderated by Algimantas Gaulia, Chief Risk Officer in Šiaulių Bankas. Hi, Algimantas. Thank you for connecting, and the stage is yours.
Hello, it's an honor to be here. So I am Algimantas Gaulia, Chief Risk Officer in Šiaulių Bankas. My experience in banking sector of Lithuania exceeds 20 years, and through these years I have worked in various positions in the fields of finance and risk management. And next month there will be 10 years when I'm with Šiaulių Bankas. So during my working career journey, first time I heard the word resilience is when I got into the positions where I had some people under me and received some managerial training, and this was something used to define personal traits. And in organizational aspect, I had this word somewhere in the operational risk field, and it went mainstream from the years of COVID, and as now last year the full-scale Russian invasion on Ukraine broke out, which added new perspectives to the resilience. So I think that this word is here to stay, and I'm pleased to have these panelists who will be discussing this topic in an upcoming hour. So let's start by introducing ourselves, and Miroslav, please be the first.
Hello. My name is Miroslav Šalša. I work as Chief Risk Officer of BNP Paribas Cardiff in Central Europe. I started, just briefly, something about myself. I started my career as an actuary, which is the position in the insurance company usually focused on the calculation of premium rates, technical reserves, and it's also a little bit aligned with the finance and with the capital management. And in year 2016, the insurance sector adopted the totally new regulation, which is called Solvency II, which really increased the importance of the risk management in the insurance business. And this was for me the opportunity to switch my, let's say, career from the actual to the risk one. So now I'm working in risk management area for like 6 or 7 years. And maybe regarding the risk resilience, for me, let's say the biggest touch and contact with this topic directly was this COVID crisis, when the company had to started to work remotely within 2 weeks. So this was less something for me when I was directly part of this, let's say, resilience exercise. So this was a little bit exciting period for us. However, it was quite complicated. So that's it from my side. Thank you.
Yeah, thank you, Miroslav. So Milan, please introduce yourself.
Okay, thank you. It's a pleasure to be here. Hello, everyone. I'm Milan Barica. I'm the head of operational risk analytics and quality management at Intrum Hungary. I've been working in the financial sector for more than 16 years, preferably in that management in more than 14 years. I started my career as a financial advisor before the crisis. It was a totally different area. And after that, when the crisis became, I realized that in the next couple of years, the risk management and the debt management will be crucial in the financial sector. Therefore, I joined to Erste Bank, and I worked for Erste more than 7 years. Currently, I have a lot of various positions regarding my main task, but beside that, I'm the transformation business lead in Hungary because 2 years ago we started to transform our organization, our processes, and we tried to align our way of working, our best practices for that. So that's all on my side. Thank you.
Yeah, thank you. Marie, the floor is yours.
Hello, my name is Mari Mois and I'm coming from Luminor Group. So it's a banking group that's established in Baltic countries. So we are headquartered in Estonia and I'm located in Estonia, but we have big branches in Latvia, especially Lithuania. And I've been working over 20 years as a chief legal officer, and now recently I've also moved to a position of chief compliance officer in the Luminor Group. So that I'm working daily with compliance risk, but also very much in our recent years, my focus has been also on resilience and other risks what we see are coming to Norway. And I'm very honored to be today one of the panelists, and I'm hoping for a fruitful discussion. Thank you.
Thank you. And last but not least, we have Petr. So please.
Hello, everyone. So my name is Petr Toman. I'm located in Czech Republic. I'm working for a sixth biggest bank on the market here in Czech Republic called Moneta Money Bank. I'm responsible for commercial workout, for collateral management, portfolio management, and I also serve as the chief risk officer for our subsidiary called Moneta Building Savings Bank. And throughout the last period, I had the pleasure to lead the risk management function throughout the COVID crisis, also from the position of a leader of collections of retail receivables, which helped me to actually understand what under such crisis is necessary also from the business point of view. So looking forward for the discussion, and Algimantis, back to you.
Yeah, thank you. So let's start the discussion by discussing, as we saw that most articles regarding the resilience stress that implementing holistic risk management approach and integrating it into strategy is one of the key success factors for building a resilient organization. So, Petr, please share your take on how to implement a holistic risk management approach.
Mm-hmm. Thank you. So, as I mentioned during the crisis, I was actually looking from the position of a collections leader also on the business needs of the customers, because it's obvious that during the crisis there is a higher potential that the customers will default. And I think that even though it's going to sound probably like something from a book of risk management, but in reality it showed and proved that it's really necessary, and that's the fact that we need to have let's say the three pillars of the risk management embedded into the organization, where it's not only about the risk management itself, but it's also about the business, which needs to serve as a first line of defense, or so-called first line of defense, and actually help to the risk people to assess the first red flags of the customers. Then as a second line of the defense, you have the risk management, which actually works with all the necessary informations which are available both from internal sources and external sources. And then on top of that, it's also good to have a compliance or legal overview, which then from the retrospective action look at the decisions which has been taken by sales and risk management, and actually ensures that in case there is some mistake or misconduct, is not going to be repeated in the future. So for me, it's quite important to have these three pillars. And maybe one more comment. I think that also what's important for the risk community and for the risk people is that we should serve as and as ambassadors across the company with regards to the risk management, and we cannot expect that the sales will understand risks. So we really need to take a step forward and try to share with the salespeople and with the product people and all across the organization what we think that the risk management means for the organization, and somehow spread across the know-how how we should prevent both defaults, frauds, etc. So this would be my take on this one.
Yes, thank you. I really appreciated your thoughts, especially sharing the competence aspect, which is I second on that, and that it's very important. And Miroslav, maybe you could have your perspective on this question.
Yes, thank you very much. Thinking about this question, maybe I have like maybe two important points which are kind of a prerequisite for the, let's say, successful implementation of the framework, and then some also like at least two, let's say, key success factors. So I think first of all, I think it's well known for the risk community, but it's, I think, still from practical point of view very important that there is a tone from the top, so that we as a risk managers are having a big support from our ExCo, because buy-in of ExCo management or senior management and engaging the key stakeholders, I think that this is absolutely must and essential, because to build the whole and functional framework on, let's say, some from bottom to up, it's quite complicated without or impossible without the engagement of the ExCo, because at the end of the day, it's ExCo guys who are, let's say, end users of the risk management framework, to whom risk management framework, let's say, serves as a support for the decision-making process, for the strategic decisions, and for things like that. So successful buy-in of senior management is it's absolutely key. Of course, for financial sector, I think insurance companies for sure, and in banks, our situation maybe it's a little bit easier because we have quite big regulatory pressure, and we have the regulation which is also supporting us in that. So this is for me one big important first point. And point number two is this is like kind of, let's say, requirement on the risk officer or risk function. It's a little transversality and some kind of, let's say, transversal skill set in the risk team or in the person of risk officer, because I think the important, at least at the beginning, is the ability to see the big picture, to make some synthesis, let's say, synthetical work and so on, because most of the risks and, let's say, significant risks and the way how we need to manage them is really going, it goes across the company, and we cannot work in the silo. So for me, like this kind of transversality mindset, it's also very important. And just like two, let's say, maybe success factors. First one is something which has been already done with Peter. So permanent working on risk culture from our side, as Peter said, we should be kind of an ambassador of that, and permanent education and training of staff and the managers. This is like a never-ending story, which is very, very important, because exactly as Peter said, these guys, they have their own missions, they have their own tasks, and somehow the culture is something which it takes time to build it, and we have to really contribute it, and this is quite important. And once I think these guys' importance, the added value of the risk and these things, then they became more cooperative together with us, and together we can achieve, let's say, more. What I also think it's important that definitely we should be able to identify and to prove, let's say, really some added value for the managers and also for the staff. We have to show something that the risk management has some, let's say, active role, and it really brings something to the company, and it is not just a kind of, let's say, a regulatory and reporting exercise. So for the success, I think we always have to keep in mind that we have to really deliver some concrete particular value, maybe to improve some process, maybe to improve some KPIs, to help people, to consult them, to support. This is, I think, very, very important to be also recognized within the company as a guys which are able to contribute to some business achievements. This is maybe like everything from my side now, and I can share with work with somebody else. Thank you.
Thank you. They're very good points. I wanted to highlight something, but I would need to repeat the whole speech of yours. But I see a common factor that risk culture is key towards having resilience. And we will have a panel on risk culture later in which where we will be able to discuss with more in depth. But also, if you look at our environment, so it is very volatile and changes come very quickly. So the agility also comes in mind. And Milan, maybe you could share your thoughts on agile approach in risk management.
Okay, thank you. The agile approach currently is a quite popular thing. I think not just in a project management, however, in the organizational perspective, but also we can use in the operational risk management as well, because of in that way it's much more flexible to handle the operational risk, or not just the operational risk, but currently I will focusing on that. For example, the operational risk management process is the overall process for doing the risk analysis is an agile environment in generally the same as a traditional. So it's more like a plan driven project as well. If we considering the phases of the agile management process, the first one is, for example, the risk identification. This is might consist of a brainstorming session to identify the potential risk and the projects. The second is the risk analysis. I think it's really great to have some kind of track records, benchmarking, in order to use the previous risk, which will be helpful or which will be beneficial to mitigate your risk in the future. The risk response. I will show you later some topics about that, but I think the responsibility is really crucial. As Petr and Miroslav mentioned, that this kind of ambassador or the representative in the departments or the directorates, it's really crucial to have this kind of responsibilities and involvement. I think that's the main point in order to collaborate and work together in an agile way, use the best practices, use the information and build in for the future processes. Therefore, you are able to mitigate your risk, which is came from, for example, that, and the monitoring and control during the project, during the risk is monitored, and control is much more stable and a great things you have, and few advantages. For example, in an agile way. As I mentioned, it's a plan driven. So if you consider a risk as a project, then you have a chance to plan. You make some milestones. You for example appoint for the colleagues or create some mitigation or action plans, which is a quite forward-looking mindset. So therefore, I think this kind of agile process is absolutely fit for the operational risk or the risk framework as well. So for us in our company is a good way to use this kind of approach.
Thank you. And Petr, your take on this?
Yeah, thank you. So I think that again, and I will be repeating myself with the culture, but I think that also for the agile approaches, understand that the risk community does have embedded in its culture that they want to understand the business priorities, because without understanding the business priority, it's never gonna support the agile approach of work of the organization as such. And what's also important is to work with the data we have and be able to do a lot of data analytics behind each release throughout the project, throughout the life cycle of the project. Because if you want to be agile in the risk management, it means that you really need to understand of how the process, how the project is evolving, and you need to constantly review the data. You need to constantly review the outcome of the latest release, and you need to be able to adjust with each window where you're releasing something new, and when you are putting in motion something new. So for me, it's really about, in one hand, the data analytics skills, which you need to have in place, and you need to be quickly react and understand what's happening. And the second is to be able to support the business and understand what are the business priorities, and not to hide behind some regulatory chipper jabber, which basically always helps you to stop whatever progress you want to make. So think out of the box and really support the business priorities. However, at the same time, understand the means which you are actually giving to the business. So that's somewhat my take.
Okay, thank you. And just as a quick consideration on the data, as if we have some new factors arising, which mostly comes with the new requirements for the data to analyze such risks. So how do you tackle it?
Well, it starts and ends with the analytical skills you have. So you need to hope, or you need to make sure that you are supported by compliance, legal, with the analytical skills of all the requirements which are ahead of you. And then you need to be able really to implement very quickly and in a very knowledgeable way everything what you should or with what you should comply into the process. And again, it's about the setup and about the way between how to support the business and how at the same time be able to fulfill all the regulatory requirements. And I think that really it's crucial not to think about the risk management in the agile world as about the function which is just stopping everything because we are not at 100%, but we need to be able to accept at least some of the risks, not to stop the progress. So I think that, you know, as a risk manager, you should be, your mindset should be somewhere around, let's mitigate 80% of the risks, and then whatever will be the rest, we will handle somewhere along the way.
Yeah, thank you. And currently, one of the factors with the most volatility are factors that influence market risks, such as interest rates, commodity prices, etc. So, Milan, could you share your take on strategies for successful control on market risk?
Yes, absolutely. It's a really hard question currently, I think, because there is a lot of risk if we're considering macroeconomic risk or the war or previously the pandemic. So I think the risk managers currently, they have a lot of work, and they have to figuring out how can they handle this kind of risk. I think it's always, if we talk about generally, it's always great to align with your businesses. I think, for example, if you are an investment company, then, for example, the investors or the global company have some expectation about their investments. I mean, the internal return of ratio, for example, you have to check that how can you align with your business on that, and how can you mitigate the risk on investments. The great thing is to check always the exchange rates, interest rates as well. In the previous panel discussion, somebody mentioned the inflation ratio, which is currently the highest in Hungary. So it's 25.7 in the latest data. So we always try to handle, for example, the risk, but it's not so easy, and it's crucial currently. If, for example, we are generally in the Central Eastern Europe, we are an investment company, so-called, because we purchasing portfolios, we purchasing some kind of debt management cases from the banks, from the financial sectors. But there is some expectation from the investors. They want to reach a certain amount of internal return of ratio. However, for example, if you check that the government bond percentages is almost the same than the expectation from the investors. Therefore, but for example, the government bond is quite a non-risky investment opportunity. So therefore, you have to align that, and you have to rethink that. How can you reach the targets? The other thing is the equity price, which is I think is a common things on the bank sector. As I mentioned, the inflation, liquidity risk measurements or monitoring. There is a lot of other aspects what you should build in your risk management framework. For example, if there is any deviation about the markets, then you have to take it into consider the market specific risk, political risk, government risk, a lot of legislation or legal environment, which is absolutely impact on the businesses, or as we mentioned, that there is a lot of regulation, both in locally and both in globally. So all in all, this all should be or would be beneficial if you monitoring and if you working on that and the data which is came from all of that, because it will be great to check. And I believe that this kind of assessment and this kind of country or market risk assessment would be great and helpful in understand the background, and maybe as I mentioned previously, you should also mitigate your risk and keep in a certain level. The level is always a question. It's if we see that in every market, in every company is different, but every company has a figure on the risk level.
Yes, thank you. And Petr, could you also comment on this?
Yeah, thank you. So what really helped us in Moneta is that we set up our early warning system for market risks, which you can understand in a way that basically we took some of the key things which we look at on the market, like FX movements, interest rate movements, both on the local and on the international market, then how the bond pricing movements looks like, how the deposit movements internally looks like, so whether we have some outflow, inflow, to understand what our client needs are actually at the given moment. And also we are looking at the ratings of selected companies and of the government as such to understand whether there is some deterioration on the market or not. And basically right now we have it implemented in a way that we monitor those risks on a daily basis. And good thing is that it does have visibility on the Exco. So it's a report which is daily shared with the Exco board throughout the email. And whenever there is a move which is higher than 10, 20, 30%, we have a comment and we have also an action plan behind that, what we should do or how we should behave. And with such a report, I'm very comfortable that if there will be something happening on the market, the fact that we have quite extensive ExCo visibility on this report, we will take actions straight away and we will be not losing time. And you know that in a volatile environment, the time is in essence. So we also experienced a situation where the interest rates were hiked a couple of times throughout the months, and all the banks had to somehow implement their adjustment in their processes very quickly, especially from the interest rate point of view. So I think that this is one of the very important and very helpful stuff which can help. And then obviously to have the visibility of the committees which are set by the board. So for example, each institution, at least in the Czech Republic, should have the Enterprise Risk Management Committee, which should be held either monthly or quarterly. And I think that it's very important if there is a summary of all the market risks which the company does face, and we have some heat map of whether all the risks are fulfilled or are not fulfilled. And again, we have the visibility for the ExCo, because the market risks are usually the big ones, and it's tough for even for a B-1 to take the decisions on such things like big movements of the interest rate or closing positions wherever you have some open hedge position, or stuff like that. So for me, the visibility and ideally daily monitoring, this is what should help to control the market risks the company is facing.
So I will rephrase it: clear reporting and governance structures, which also are part of the risk culture, contribute to successful management and prevention of extra losses. And speaking of volatile environment, we still have some risks that are non-preventable. So how can organizations identify and prepare for non-preventable risks? So Marie, please share your thoughts.
Yes, well, non-preventable risks is non-preventable, and luckily not. There is only like very minor percentages of such risks, but time occurs when these risks are actually coming to the play. And I think that the most critical thing is to have actually a long-term view and have a foresight. So what are these possibly non-preventable risks what we are facing? And as no one, I can bet no one would have predicted the COVID situation, where the whole world at one moment stopped, that I could walk in the middle of the street in Paris without seeing any person. Then the birds were coming back to the cities. So this type of things we can not prevent, but they really happen very rarely. So this is the beauty of it. Also, as was mentioned before, the Ukraine-Russia war now. So this is another like non-preventable risk, but nobody would believe a year before that. So definitely something what we couldn't see. But what to do in order to get hands around these possible risks? So, and this is already mentioned also by my colleagues of panelists here. So, but I want to emphasize it is actually the diversity of what we're talking about here. So we can say that these are skills, experiences, etc. But this is the diversity what we as a world need. So you have different views. And what I mean here, and my personal example here, is that I've been working a very long time in a subsidiary. What was a local subsidiary of one of the big Swedish banks in Estonia. And in our risk management, it was local people doing it. we were the same local people from the same university sitting around the table. Even though the universities were different, then the same lecturers were like going to one university to another, so that the experience what was shared was different, or was the same basically, so not different. And if you see also that around the table there are same age group people, same sex people, same, then you can see that and year after year, then it's very clear that the views are very similar. Of course, people who are training themselves will get some new insights, but still the focus and understanding of the world is the same. So now I moved over to the Dominor Group, what I mentioned also before, what is working in 3 Baltic countries, and we have a very diverse management team. We have very diverse risk team, and our views are also very different. We come from different backgrounds. We come with a very different age group. I'm very feeling much more secure also about the future, because there are less black swans, there are less unknown vulnerabilities. So, and we can better prepare for that. So another thing what I want to say is that personalities are very important. So that we need to have dreamers in our team, so that who could think of unthinkable. So who can dream that there might be like 3 negative contexts, that there might be a war. So what we would do in case of the war, if everyone is a realist, like good legal risk finance people are, we are realists. So we are pragmatic and we take future as it is. But then we need also people who are looking backwards and the people who are looking very much ahead of us. So the visionary type of people who can say that what might happen and what would be interesting also to discover. So yeah, my point here would be the foresight, flexibility, and mostly let's have a very diverse team. So that would help us a lot.
So thank you, very interesting take. And recalling from the previous panel discussion, I commented that those companies with diverse streams of income or supplies are also more resilient. So it has also a point that the staff also needs to be diverse, and this contributes to the resilience. Miroslav, could you please also share your thoughts on this?
Yes, for sure. Thank you very much. So in relation to identifying of these risks, I think that it's what we a little bit also discussed before, that the risk officer or risk teams or those guys who are here for identification risk, they have to be really open-minded and try to be really open to all possible streams, to all information sources, to follow somehow regulatory, economics, general business topics, really to be able to bring to the company all possible, let's say, risks and threats, which could, let's say, occur, and to try to put them into the standard, let's say, risk mapping process to secure that all those also possible emerging risks are somehow at the risk radar of the companies. But I think even though still we have to be fair to us that there are some risks which we never be able to identify, and there are still some black swans. This is, I think, something which in general we cannot avoid. More, I think it's then identification. What's more important is to really think how to at least try to mitigate these risks. Also, in the case that some, let's say, things which have very low probability but possibly very high impact, if they are occurring. So, what would be our response? What would be our strategy to survive and to mitigate risks? Because if for me some risks is like non-preventable and identified, somehow I have to be sure that at least like we survive as a company, that we are not ruined. And this is also connected with this operational resilience, exactly as Marie said, the diversification, diversity in general, and so on. In insurance business, for example, there are some risks for example, natural catastrophes, which are like non-preventable, but it's just a question when the risks happen. And for example, what would be the size, what would be the materiality? So I think, for example, for such a cases, which we are able at least to identify, we have to prepare ourselves to be able, for example, to survive the floods, which are happening at least once 500 years. We have to be sure that in such an event, we would have enough liquidity to reimburse our customers, that we have operational capacities to manage such an event and so on. So I think that in principle, we have to be at least open-minded and still to focus, to try to search for some possible strategies, at least how to survive if we are talking about some big things, like, for example, war in Ukraine. That's I think from my side. If there is some query or something.
Okay, thank you. So you mentioned natural disasters. So in case of such disasters, be it natural, political, so how do you assess the importance of resilience?
Yeah, so for me, from question, I think not just for me, I think for all of us, the question of resilience of big companies, also financial companies, but not just financial companies during the natural or political disasters. I think this is really the key, because most of our customers and also the population and the society, they are somehow expecting that all those key companies are working and supporting the customers during natural catastrophes and also during political disasters. So for me personally, of course, the natural catastrophes are like easier, because you can be better prepared and they are than the political ones, and they are, I think, for me, more easy to be predicted, because you have some data, you have some models, you have some probability when some earthquake can come, you have some probability where there could be some windstorm, tornado, a flood, and something like that. So somehow for the natural risks or natural catastrophes, you can be much more prepared and to build some kind of, let's say, to have enough capital to survive. This is what I said before. You can be prepared from the operational perspective to be able to support customers to pay the insurance claims during that. So this is something which even if such an event occurs, I think that you can be much better prepared compared to political disasters, which from my perspective could be very blurry, and it's much less easy to predict such a things. Because today, I think all of us in all Europe, but not just that, we are living in a very volatile world. We have increased, I don't know, international tensions between the states or between some blocks. The reality, I think, from international perspective, we are not living in such a happy world that as we lived, for example, 10 years ago. In I think most of European countries, there is an increasing voice of the populist or some extremists. So it's really very difficult here to predict which kind of new regulations, some sector regulation, maybe some new taxes or something what could come. So political disasters, it's I think big topic, and as of today, I don't have some, let's say, easy or strategy, let's say, how to work with it. We have to be open-minded, but it's more complicated compared to the natural disasters, definitely. At least I think for insurance sectors, here we are quite natural to work with the natural disasters. This is a part of our business. But political disasters, it's really big topic, I think, also for all of us, for the risk community, to really think about it for the future. Because I think, for example, now speaking from Czech Republic, last 20, 30 years after the fall of the communism, we were living more or less in a very favorable political environment. Not too much. There was a transformation. There is a political ethos. The whole companies was more or less the following the leaders. So somehow there was some kind of a consensus. This is now a little bit, I think, breaking. It's a spreading. Company is spread it usually for big, let's say, at least two groups. There are more tensions than before, so it's a topic for upcoming future. Not the easy one, not the lucky one, but something we have to think about.
Thank you. And Marie, what is your take on this?
Yes, also like how to political and natural disasters and this environment. I think that firstly, what has been again like my experience here is that we have prepared for the crisis. We have done the crisis plans. We have reviewed the plans annually, tested the plans. But I think that this is in all banks and insurance sector definitely for sure the same, that you are preparing for the worst. But at the same time, the company's overall and also senior management's perspective to these plans have been like a bit like, you're overdoing, it's ridiculous, so why do we need it? It's just like a paper. But I think that now this actually, due to the COVID in 2020, has changed, and definitely the Russian crisis here and also the inflation. So these are like big things, but are also like really changing the game. And what we have learned also now is that the siloed approach is not working. And then under this, I mean, not the siloed approach at second line, third line, and first line. We are siloed, but overall the siloed approach, because we need to think much wider also in risk management. We don't need to think only about our own sector, but we are so dependent on different sectors, so that, for example, if I'm buying now or insourcing IT services from let's say X country, and now the political situation in this X country is changing, so that we put sanctions on this country, then it raises lots of big issues. Political disaster is basically in this X country is causing me a big problem in my country, and not my country but my company. So that this siloed approach, we need to look at the domino effect of everything. So that we need to have a very wide oversight, as Miroslav also said, that we definitely need to see the problem from very different angles. And I'm coming back to my statement that diversity helps to look at the problems, but we need to also understand that the domino effects of different natural disasters. So refugees coming, and this is something what we need to just think of, because at the end of the day, we want our companies to succeed. We want personally to succeed, and this we can only achieve if we are taking a forward-looking approach in our risk management side. So also personal risk management.
Okay. Thank you. And we are coming to the end of the panel discussion, and we have a question from the audience. So could you share some tools or tech that you use to implement risk management strategy or identify risks? Who could take this question?
I will maybe start. So I think that the tools how to identify risks, and this will be used in the company. We do have. I'm from the banking industry, so for example, when we are launching a new product, we have a so-called new product inquiry, which is set by the risk management function, and basically we are trying to have from the business the most critical answers to things which we see or perceive as risks. So, for example, whether the product will be sold to a wider population or whether the product will be sold to kids, because when it's for kids, there are different types of risks. Whether the product will be secured or unsecured, whether the product will be sold through third parties, as well as internal distribution, as well as, for example, online, or it's going to be just an online product, etc. So basically to have a set of queries which over the time you are constantly updating given what's happening on the market, and basically for each product launch, or you can then implement it also to the processes for each new process. You have basically some kind of a checklist which if it's not filled, you cannot proceed further. And this helps you with the identification of risks. And over time, you also, by updating this checklist, you basically cover more and more. And when we one more thing, which throughout the discussion was not yet mentioned, however, I think it's very important to also mention is, and that's for the non-preventable risk, at least for the time being, for me, that's the cyber risk, which is currently all over the place. And I think that it should be not underestimated. And from the most recent research I saw, which was provided by Ernst & Young, basically all the CROs, they think that the cyber risk will be one of the biggest one in the upcoming period. So I would really encourage everyone to also think about how to mitigate the cyber risks and how to implement in the processes within which you identify the risks, also the aspect of the cyber, because it's going to be a big one. And especially with the Russian-Ukrainian conflict, the hackers are more and more visible and all over the place.
Yeah, thank you. I can double on that. Let's say Lithuania faced a series of cyber attacks throughout last year due to this Killnet Russian group, and some of with some state companies were partially successful. So it's a very important factor to consider. And I see that Milan wants to add something.
Yes, just follow the previous dialogue, because yeah, we also use this kind of new product, but I would say for us it's a new. Yes, sorry. Jaroslav? Yeah.
Yes, just that I also had a couple of words afterwards, so please continue, Milan.
Okay, thank you. So we use almost the same. I would say it's a new product approval process, so the MPAP. So when we try to implement or do a new business, for example, when we acquire or we buy, for example, a couple of years we acquired Aegon Credit Institution. So it was more like a mergers and acquisition. Therefore, we have to build up this kind of MPAP documents, and we separated for a lot of categories. I mean, HR perspective. If we acquire a big business which is related to the organization, therefore, how can we align the organizations? The other is the IT aspect, that, for example, the products which we acquire is able to handle in our systems, or we have to develop our system. There is any conditions before we implement this kind of new business or investment perspective. What is the expectation of the investors or the global management, and a lot of operational aspects from process perspective, regulation perspective, compliance, legal, etc. So yeah, we always do the same. And just one thing, because I think if we talk about the tools, there is a lot of tools available in the markets which everybody can use. For example, we talked a lot about the agile way of working. We build up our operational risk frameworks in the Jira system, which is absolutely a project management tool, an agile project management tool, connected a lot of Confluence, a lot of other interfaces with our core system. Therefore, we are able to handle the risk in an agile way. So, for example, Jira is a great way, but there is a lot of other system which is available. So the main thing is the tailor-made or the customized solution which is fit for the business.
So, thank you. And Miroslav?
Yes, just I wanted to add a little bit something to Milan's and Peter's speech. Yes, also in our company we have a similar, let's say, process of risk identification, which is connected with some launch of a new product. And exactly as Milan said, so I don't want to repeat more or less what the guy said, because our process is more or less similar. But as tools as such, yes, I think also, as Milan said, there is a lot of tools on the market. You can use some heat maps comparing severity, likelihood, imminence of the risk, and something like that. Important is what two guys before were talking. It's that, let's say, these tools and processes are integrated, let's say, within the business and within the real processes. And this is, I think, nice example what Milan and Peter said, that you can see that really how these guys are really contributing into particular processes to the business. That's it.
Thank you. And there is also another question from the audience. Could someone share quantitative risk indicators for calculating risk?
Yeah, so for example, maybe if I can start for insurance company, for some of them. So one of the key of us is a so-called solvency ratio, which is the indicator providing you information. Let's say how much own funds you have about the solvency capital requirement, which is driven by the regulation. So this is very important. Speaking about insurance companies, for so-called underwriting risk, which is the traditional insurance risk connected with our core activity, we are following claims ratios or pure technical loss ratios, which is comparing the paid claims amount compared to premiums collected from the customer. This is important indicator telling us, let's say, how our premium rates are able to cover the underwriting risk inside. Of course, then we are following a lot of market risk indicators, liquidity indicators, and stuff like that. From operational point of view, what we are now focusing, for example, a lot is turnover of HR, because, for example, in Czech Republic, the labor market is very complicated, and still we have very low unemployment rate. So we are carefully following the turnover, the number of, let's say, the delay in the recruitment positions, to see if our offers at the job markets are attractive, not how long does it take to us in average to recruit some expo positions and so on. And of course, the incident monitoring and some losses coming from the operational risk incidents, it's also something I would highlight especially. But answer is not easy, because we are more or less following really a lot of KPIs, a lot of indicators. It just depends at how level and what is the detail.
Yeah, Milan, please.
Yes, as Miroslav mentioned, there is a lot of KPIs we have to check and analyze. Just a few from our sector. The NPL ratio, non-performing loan, is really crucial. The loss given default, the probability default in the debts, and in the loaning procedure, the loan to value is also crucial. That what is the ratio on that, leverage ratio. So there is a lot of ratio you have to check and analyze. I think almost I repeated myself. The main question is that what kind of business do you have? Banks, insurance company, financial institution, which is the main focus, and you have to align your KPIs and your figures for the business.
And Petr?
Yeah, I just wanted to add for the banking, the capital adequacy ratio or net stable funding ratio. Those are the big two ones which you have to follow. And maybe one comment to the KPIs. It's at least for me, it's not only about KPIs, but also about some kind of a management buffer for what's important from the regulatory perspective. So, for example, for the capital adequacy ratio, if you have the capital requirement of 15%, it's always good to have at least a cushion in your KPI, so that for the management you have, for example, 16%. So really also work with some kind of unpredictability and with some non-preventable risks which are embedded in this cushion which you build into your KPIs.
Okay, thank you. And the last question from the audience, which is a bit specific. In case there is a high volatility of exchange rate, in what ways can risk be controlled? And we are in the last 2 minutes of our discussion, so this is the last question.
I think that if I will follow on one of my previous comments, it's about the early warning indicators, so that you really know straight away what's happening, and then some strategies how to mitigate it. So basically, whether you will have a strategy that you will close the gap on the currency, or if you are providing loans in a foreign currency, that you will, for example, stop providing those loans straight from when you find out that there is something happening on the market, or these kind of approaches which prevents to increase the magnitude of the loss which you might be facing. So this would be my answer.
Okay, thank you. And unfortunately, that's all the time that we had allocated for our discussion. I really appreciated the thoughts that I heard during the discussion, and I'm looking forward to the upcoming panels on risk culture and risk data, as this discussion showed that these are also very crucial topics. Thank you.
Thank you. Bye-bye.
Thank you.
Thank you, everyone. Bye-bye.
Thank you. Bye-bye.
I would like to thank all the panelists for this discussion. All the topics is very relevant and interesting. And I would like to present our next speaker, Milan Baritsa. He's a head of operational risk analytics and process development at Intrum with the presentation called Operational Risk Framework. Milan, stage is yours.
Thank you. I will share my screen. Just a second. I hope you can see my screen. Can you see my screen?
Nope, Milan, I don't see it.
No? Okay. No.
Yes, now I can see.
Okay.
Yep.
Just a second. Okay. Thank you. As Dostan mentioned, that I'm going to talk about a bit more the operational risk framework. Let's show you that what will be the topic on this presentation. So first of all, I would like to give you a brief background of the regulations or regulatory perspective. All of the panelists and all of the panel discussion, we related this kind of regulatory perspective. So it's really important and crucial for the operational risk management, because that is the basis of that. We also mentioned the 3-line of defense model. I will show you some thoughts about that. And after that, I will going to talk about a bit more about the risk management, operational risk management measurement approaches, methodology, the high-level processes, the roles and responsibility, which is more like a customized for our company. So I will give you some practical information about the operational risk management, and after that, I will show you some impact and probability matrix which we use, and the risk scales which we built up in the past. First of all, let me introduce myself. I have been working in the financial sector for more than 15 years, preferably in the debt management more than 14 years. Before Intrum, I work for Erste Bank, and I tried myself in a lot of various positions, from risk management throughout the debt management sector, and also I was a few years a portfolio manager. Basically, I'm an economist. I have a Boston Terrier, and I used to play water polo for 20 years, which is the most popular sports in Hungary. Beside my current job, I'm the transformation business lead in Hungary. So let's jump to the next slide. Just briefly introduction about Intrum. I think everybody knows, because in this region is a quite big company, but just in order to to show you some background, because our presentation, maybe I will focusing on some aspect which is absolutely related to the debt management sector. So Intrum is a traditional debt management company. We separated two main businesses: the credit management service and also the portfolio investment, which is more like a portfolio purchasing procedure. Beside that, we have a lot of services: credit optimization, e-commerce, payment services, account receivable management, financial services. So it's more like or it's equal than a shared service solution in a lot of countries. So let's start with a international regulatory framework, so the Basel. I think it's really important to mention that, because the Basel framework is the basis on not just the operational risk management, however, the financial stability as well. As you can see here, the operational risk is absolutely based on this kind of frameworks. There is three pillars. We also talked about in the previous panel discussion, that is absolutely focusing on the financial stability in the financial or the banking systems. There is a lot of capital basis requirements, credit risk requirement, and also market and operational requirement. In the pillar 2, there is a lot of supervision, dialogue, firm-wide corporate governance, supervisory colleges, etc. Maybe to their presentation, there was details about ICAP. So we can see previously that how it looks like in a bank, and also he mentioned some kind of SREP regulatory requirements and way of working on that. And the third pillar is consists of the disclosure of requirements, transparency for markets participants concerning the bank's risk positions, comparability among banks, regulatory capital components. So it's more like a transparency for every bank in order to see the position on that. So I show you a bit more about the three line of defense, which is a requirement from the European Central Bank. So I think is absolutely fit for the operational risk management. Here you can see the first line, which is absolutely meaning the risk management. It has got the responsibility of the full ownership. It's a daily activity, day-to-day business, including management of risk, follow the requirements, follow the regulations, collaborate with the colleagues in the organization, and provide some information for the compliance, for the internal audit. So it's absolutely flexible and daily activity in the business. The second line is the risk control and the compliance. It's the difference is the first line and the second line is maybe the frequency. So the risk control and the compliance control is more like a quarterly basis reporting and measurements. So when the risk management do their activity day by day and provide information for the departments in the organization. Other hands, for example, the control, the risk control or the compliance, they check quarterly that, okay, what was the measurement, what was for example, the mitigation plans, action plans in the related risk, whether if it's good or not, it was aligned with the regulations or the government legislation or something measurements which is internal or external, because both are really important. And after that, for example, if they have any additional information or they want to change something, change the mitigation plans, change the deadline, change the category of risk, or give more impact or priority for that, then, for example, before the reporting, the operational risk management have to manage this kind of activity, and also the information security is a part of the second line of defense. The third line of defense is the internal audit, which is a annual activity. It's a much more a traditional plan-based procedure. I mean, the internal auditor have a annual plan, what will be the focus area on the year, and how they monitoring and how they control the fields, and there is a yearly discussion between the fields. So there is some plans, there is some milestones, there is some goals. How can they reach the targets on the internal audit? So it's more like an annual procedure. And yes, every company have external audit. So this all of these lines meaning the three line of defense. So we also do this, and we also established previously, and it's absolutely aligned with the operational risk management. Let me show you some information about the operational risk approaches, which is mentioned in the previous slide. First is the basic indicator approach. It's more like a non-risk sensitive approach. So it's a simple procedure which is maybe used in a smaller company, not just banks, because banks and financial institutions use the more like advanced approach based on the 15% of gross income. So therefore, when they do some provisions, then they have to align with this kind of requirements. The second one is the standardized approach, which is also a non-risk sensitive, based on the weighted percentages of gross income per business line. There is a lot of business line which is available. So, for example, corporate lines, investment lines. So in this approach is absolutely based on that. And the third one is the advanced measurement approach, which is absolutely a risk sensitive, involve complex statistical models, uses day by day, but it's not a standard methods. Therefore, which we also talked in a previous panel discussion, it's absolutely allows this kind of flexible or agile way of working. Here you can see some information or more details about the advanced measurement approach. First is it consists of 8 business lines: exposures indicators, probability of event, loss given event, which is really important because, for example, in the debt management sector, it's crucial. We have to monitoring that what is the probability of default, what is the probability of for example, they don't pay their debts, and what is the loss given default, what will be the impact if they don't pay back their debts. The second one is the loss distribution approach: frequency distribution, severity distribution, aggregated distribution, the value at risk, because the 99.9%, so we try to keep this level. not we, but that's the requirement from this approach. And the third one is the scorecard approach. I will show you some example in the risk scales, impact, and probability matrix, which is a great so-called tool to monitoring and analyzing your risks. Okay, so here you can see some example about the operational risk management methods or methodology. I separated for two main category. One is the types. I think just few words about the types. The people. What am I think when I'm talking people risk? It's more like competencies, recruitment or retention rates, because currently there is a lot of colleagues quit their job or leave the company. How can we keep the turnover ratio in a great level? So I think from HR perspective is really crucial to keep the level in a great way. Human errors, internal so-called crime or management or culture, because for example, if the colleague's not absolutely comfortable about the culture, the corporate culture, it generated maybe a risk in the future. If we jump to the processes, for example, within that, inadequate processes which generate risk in the future, change or project management, documentation, any framework which is not absolutely aligned with the way of working which the company use, or governance or something like that, or more like a decision mentality, and all of that is generate a really high risk. For example, in our, I don't know, maybe more than 30% of the risk came from the IT, because currently every process is based on the IT systems, every data based on the IT systems and the reporting, etc. So it's really crucial to keep the IT risk level in the lowest level as we possible. Okay, and maybe some thoughts about the external risk, macroeconomical risk, political risk, legal environment. So if it's always changing, so it's crucial, and the relations, partners, customers, third-party providers. So this kind of relations is really important. If we see from by categories the risk, there is a lot of compliance and legal regulations which we have to follow. So therefore, it's really important to see the internal and external regulation, the requirements from the national banks, from the financial supervisory authorities. So it's really important to monitoring, and therefore in the three-line of defense model is really crucial to have a great collaboration between the compliance and the operational risk management. Therefore, you are able to follow this kind of regulations, and if you have a great dialogue between these two fields, then you have to mitigate not immediately, but as soon as possible. Okay, macroeconomical. It's I think currently is absolutely important, because as we can see, there is a huge amount of inflation ratio. So we have to monitoring the macroeconomical situation or circumstances, how it will be impact on our businesses, what should we do to mitigate our internal risk, which came from the macroeconomical situation. Okay, and the financial one, which is, for example, related to the investments or new businesses. We also mentioned the new products which we try to establish in a business. So that's all. I'm not gonna through all because there is a lot of aspect on that. Maybe just a few words about the last one is the sustainability, which is currently it's a new categories in the risk management. For example, at Intrum we established in the last year, but as I see in a market or in a sector, there is a lot of other financial institution and banks who also established this new risk category. Okay, this is the high-level process in the risk management methodology. First is the risk identification, where you can see the purpose of the risk identification to identify the risk, describe their impacts, describe the controls, and assign risk owners or responsibility persons or something like that. Risk evaluation, I will show you some example on that. I think it's really crucial to evaluate in a really great level and always monitoring what will be the impact on each and every risk by category, by types, as I mentioned earlier. So it's what will be the probability, what will be the impact on the risk. So it's and therefore you will give a score which is show you that how crucial the risk, for example, in the evaluation or the assessment process. Risk mitigation is absolutely a flexible and collaborative period of the process to ensure that all of identified risk will be mitigated and will be handled, and there is a chance to reduce the risk on that. I think this kind of mitigation plans is really important because in the future you have a chance to use the information about a lot of mitigation plans, which is more like a forward-looking mindset. So operational risk, not just the traditional risk management, because we always use the benchmarks, we always use the track records in order to avoid a lot of future risks. And the risk follow-up is also really important to check that, okay, the mitigation was successful, we had a chance to mitigate our risk, etc. Okay, let me show you a high-level process of our risk management processes. We separated 4 lines: identification, evaluation, mitigation, and monitoring reporting. First period in the identification, I think we have to separate 4 roles. First 2 boxes, the risk detection. When we built up our operational risk framework, we involved the colleagues in order to, and we gave trainings on the colleagues, because they have to realize that what will be the risk and how can we handle. And another part on that is the representative, because we appointed. We also mentioned in the panel discussion, it's more like an ambassador or representative. I would say for Intrum, or in Intrum, it's representatives, but it's absolutely work on the departments or the directorates, because they really know the business, they really know the department's way of working, and they have a lot of information about the daily activity. Therefore they want to, and they're able to provide really great and useful information for the risk management and for us. The second is the evaluation and the risk reporting. In this process, we also discuss with the representative, okay, that was the submitted risk, how will impact on our business, what is the category, how can we handle it, and on the top of that, we can make some really specific mitigation or action plan, which would be beneficial, which would be mitigate the risk. And we also determine the deadlines, what we'll try to reach. The fourth one of the line is the monitoring and reporting. Here you can see that after the mitigation plan, the traditional risk management is started. So the operational risk management reporting, reconciliation with the compliance, and discuss with the compliance. And after that, all of discussion will be done. Then we will submit for the operational risk management committee, where the management approve or give some information or ask some changes or condition on that. Okay, and the last one is the reporting when we submit the reports. Just few things about the roles. As I mentioned, that we involve the colleagues in order to everybody know that what is the risk, how can we realize the risk, how can we handle if somebody see that, for example, some document is missing and it's absolutely impact on our daily activity, and the impact on that is really high. Okay, that what is the process and how can we mitigate? The second is the risk owner, who will be able to make some decision about the risk. What will be the deadline? How can we mitigate the risk? If it's related not just one department, then they have a chance to discuss with other departments as well. As I mentioned, that we appointed some departmental operational risk representative, which is really helpful because it's absolutely such a professional discussion about the fields, and it's got a lot of information. Maybe one thing is the operational risk management. It's in our business, the operational risk management committee, including the management of boards or the director of boards. So it's absolutely on management level, because they have this kind of competence. They have this kind of responsibility on that. If for example, some changes is necessary, then they do the decision. Okay, this is what I mentioned before, the operational risk and risk impact and probability matrix. Here you can see the impact, here you can see the probability. We use 1 to 4 scale, and therefore when we for example try to check the risks and after that make some scores, we can see that is it critical risk, or it's a major or limited or minor, and this is the likelihood and occurrence informations. Here you can see that how we built up in our business. For us, it's absolutely fit for the business, and it's absolutely a great chance to monitoring and keep the great level of our risks. Okay, and sorry for that, it's a bit noisy, but just I wanted to show you that by categories, how can we categorize our risk in the impact. For example, you can see in the financial stage, we absolutely align with our EBIT figures. So you have a chance to align with the global level or a local level. Previously, we used global level. Currently, we use the local level. Both of these, it's absolutely okay. However, I think if you use local level, it's much more market specific, and it's provide you more information about the risk, and it's I think it's a great thing to use this kind of level in the local one, and you can see a lot of other strategic scales. So I think that's from my side what I wanted to show you in a risk management perspective.
Thank you, Milan, for this very interesting and informative presentation. And we have a question from the audience. Do you use any AI tools, and how?
We use more like BI tools, not just AI tools, because the debt management sector is, how can I say, it's more like in Hungary, it's an old school version sometimes. So if we're considering the compliance regulation and requirements from the national bank, then they not allow us to use that. We used voice analytics recognition previously, but there was a penalty in the bank sector, so now we don't use that.
Thank you, Milan. Thank you.
Thank you.
Appreciate it.
Thanks for having me.
And dear viewers, now we're going to have a short break. After that, we will come back with a module called Risk Culture, and we will be back at 1:30. Enjoy the break, and see you all soon. Hello, everyone, and welcome to the module number 3, which is titled Developing Risk Culture, and will focus on the importance of creating a risk-aware culture within an organization. The module starts with the panel discussion, which is called Fostering a Culture of Risk Awareness in Your Organization. The discussion will be moderated by Peter Gapko, Senior Risk Manager and Chief Economist at Moneta Money Bank. Hello, Peter, and the stage is yours.
Hello, Destan, dear ladies and gentlemen. Thank you for giving me the floor. It's my honor to moderate a panel on the risk culture, and just introduce a little bit myself. I'm based in Prague, Czech Republic, being part of Moneta, which is 5th or 6th largest banking institution on the market. Today we have 4 panelists. Each of them is very senior in his or her institution. So we start with Algimantas Galia, who is Chief Risk Officer in Šiaulių Bankas, based in Lithuania. Algimantas will tell some insights about ESG considerations in risk management, as this is one of the key topics probably for this and the following years. So Algimantas, the floor is yours.
Thanks, Peter, for the introduction. So we are hearing a lot on the ESG, and I'm sure that if the COVID pandemic and Russian invasion on Ukraine did not happen, this would be even a bigger topic than it is today. And I'm sort of happy to say that Šiaulių Bankas as an institution has had a European Bank for Reconstruction and Development in its shareholder structure for quite a while. And we taught us to think about ESG issues before it was such a trend. So in the commercial banking sphere, the hot topic is the E element, as the new regulations quite a lot of regulations are incoming that are addressing climate and environmental risks, physical and transitional especially. And these regulations, of course, need to be addressed properly. So the largest focus is here. Also, G element is, I would say, also quite pronounced for the banks, as governance assessment is a crucial part of the threat regulatory assessment process. Also, some of the banks are rated companies, and status of issuers creates another set of expectations that need to be addressed and are being addressed by the bank. And S letter, social, is probably the least regulated one, and it is coming mostly from internal initiatives, and probably most organizations have their marketing or similar divisions who are responsible for this. So if we look at what is needed to be done for the ESG, so the banks are expected to have integrated ESG risk governance into all of the spheres of the organization, including risk materiality assessment, including stress testing, and there will be disclosures mandatory starting from the next year, as Pillar 3 forms are already there. So our approach is that ESG is not only a risk, but it's part of overall governance framework. So it is important to have it embedded widely within the organization. And we strive that every structural unit would consider ESG in its objectives. To facilitate that, we have launched a sustainable action group. I am chairing this, and I'm also a member of management board responsible for ESG issues, and it has about 10 members from very various parts of the organizations, including product development, sales, administration, supplier management, even subsidiaries. And the role of this group is, I would say, spreading the culture of risk as to discuss relevant issues, to share competences, insights, to monitor implementation of ESG strategy, to discuss issues. I consider this group as a very successful decision and tool that helps us in the risk function, that we have studied the regulations, we know the expectations, we have the expertise, so we can spread such competence throughout the organization. So initially that, and we'll be happy to answer any questions.
Thank you very much, Algimantas. It's according to my observations, it's quite common that CRO is usually the member or the board member responsible for the ESG areas, and we'll definitely get back to you because already now I'm thinking of several questions to the ESG topic. But let's now introduce Paula Mihaescu, who is our second panelist. Paula is a country ethics, risk and compliance head in Novartis. So we are switching from banking, and Paula will probably give us a little bit more insight on how it is with the risk team skills and how the risk function might develop in the future across different industries. Paula, the floor is yours.
Thank you, Peter, and hello to everyone. As Peter mentioned, my name is Paula Mihaescu. I'm country ethics, risk and compliance head in Novartis Pharma, Romania, which is a Swiss pharmaceutical company focused on reimagining medicines to extend and improve patients' lives. So now we are switching to pharma sector. During this panel, I will deep dive into the risk team skills and how the function is projected to be oriented in the future in terms of people, not just in banking, but across various other industries. Company strategies bring opportunities for their stakeholders and society. At the same time, strategies, as you all know, carry a certain degrees of risks. Many of these relate to our business environment, such as the inherent uncertainty or changing social or regulatory expectations of different business sectors. All the industries have undergone significant disruption in the last few years, with increasing regulatory pressure, advances of technology which happen very rapid, and the emergence of fintech. All this put pressure on the companies to act quickly. The COVID-19 pandemic has added to the challenge, the war in Ukraine, and many other events as well. It is said that successful companies do not waste a good crisis. They learn, adapt, and turn the story around them, conveying threats into opportunities, gaining stronger positions. And basically, this should do also their risk teams. So continuous learning and adaptations are key words. There is somehow a sense of urgency to reevaluate the future of risk management and challenge even more how it can better support teams and organizations in the future. As the pressure is growing, external challenges are rapidly occurring, there is no longer enough to be a fast follower. We need to be ahead of things. So projections of the future in order for effective risk management systems and culture to enable dealing better and faster with uncertainties and risks, complex and volatile landscapes, still enhancing the capability to create and protect the shareholders' value, consider risk functions to become more adaptable, dynamic, and flexible. Risk functions and teams are considered now innovators, putting their stake on digital transformation, on data analytics. So risks are transformed into opportunities. increased responsibilities and stronger awareness of the business and their teams in effectively managing risks. Organizations are now reevaluating the set of skills of how risk professionals should have, from a shift from the traditional approach, which focuses more on past events, to a more adaptive, dynamic, real-time integrated style. Skills like business acumen, impact, personal impact, innovation, data and digital will be even more in focus. Developing a continuous learning and growth mindset among the teams while having the concept in mind that the only constant we are now facing is the change. Risk resilience teams are already focusing on improving frameworks, methodologies, standards, but supporting better and developing clear accountabilities and responsibility for risk owners, who are actually the business owners, creating transparency and simplification for them, improving governance and oversight, improving control landscape, and giving them harmonized methodologies, enabling them to manage risks more efficiently. So, besides setting the right tone at the top and drive effective risk management, companies are now interested in fostering an environment where everyone feels comfortable to raise concerns, encourage sharing of experience, learning from each other, learning from successes and mistakes, managing risk continuously through risk identification processes, monitoring, reporting, dedicating workshops, so basically training the business, while striving to embed this risk management into normal course of business, and mostly assigning clear accountability for managing risks. Now, looking into the future, it will not be just about identifying a few bad apples which might trigger risks, but rather empowering all the business associates to be an active and integrated part of the risk identification and management process, educating them, doing what's right, and be more forward-looking. In a nutshell, both companies and professionals need to be continuously alert and to learn and adapt. Apart from professional experience and expertise of individuals, the standard set of skills that we all know, professionals will also need to share the right attitude, showing curiosity and permanently willing to learn, to have the growth mindset and to innovate. That is it from my side for current moment. I am looking forward to the discussions.
Thank you very much, Paula. And according to your speech, I think that also a project management is a skill that will be definitely needed within the risk function. Thank you. We'll get back to you shortly with the questions because I have a few as well for you. And we now continue with Mari Mois, who is a Group Chief Compliance Officer and board member at the Luminor Group. And given her experience, Mari will surely give us some insights into the risk culture and into the fact whether there is a good risk culture or what is the common features of a good risk culture. Mari, the floor is yours.
Thank you so much. And I'm glad that this topic is getting lots of attention in our risk colleagues all over the world, but also from our regulators. So it shows that this risk culture topic, together as a culture topic, is more and more important because people start to also understand that not only, like I want to say, cash is not the king anymore. So that there are several more things that we as a humans, we as organizations, we need actually to have. So and culture is one of them, and risk culture definitely is a big part of overall culture. So and to show also the importance of the topic, Luminor Group, Luminor Banking Group is under direct supervision of the European Central Bank, so as many banks in Europe, and latest priorities, everything. It's very clear that the risk culture is under the scrutiny because of the turbulent times. We also in earlier session were talking about the risk resilience. So risk resilience is helped a lot with a good risk culture. So, actually, I have to say that not to advertise here anybody, but anyone, but just this week on 15th of February, the ECB sent out also a newsletter about the risk culture. So everything what is there, I'm not gonna repeat, but it's a good reading. It's really reflecting also my understanding of importance of this topic, etc. So that the sound bank has a good risk culture, strong risk culture, and that's what we want to have. Different companies can have very different risk cultures and be very happy with it. But in case of banks and looking at the public interest and our depositors whose interest we have to, according to our laws and regulations, protect, then this strong risk culture is really important. But your question, Peter, was that what would be like a good risk culture and what I've seen. So I've been working in 3 different banks. 2 of them are Scandinavian banks, different Scandinavian banks, and then one is the Luminor Group, but this newly established bank with a Scandinavian root, but still a new one. And we are working very heavily to strengthen our risk culture. We feel that our risk culture should be more mature, and we have done several analyses of our risk culture and what needs to be done. And here I would say that what is our aspiration? So what we see as a good risk culture, and where I can sign it off also from my personal view, is that the good risk culture is a risk culture what is invisible. So that you don't see it, you don't think about it, but you follow it. I've been working in an institution where we had such a culture that everyone was aware about their own topic, the ownership of topics, the tone from the top. It was so naturally coming that you didn't notice it. You were not pushed into it. And that's what I feel is very important, because right now we are also really pushing our employees. And yes, we need to talk more about the risk culture, and people get a bit protective against it also. But one day, the maturity level of the first line, of the second line, will be there that the risk culture is really something what we live by. So that also on your road, you see that there are these traffic signs. So you know what will happen, but you don't really think about it. So that's what I see as the good risk culture, that you follow the route. If you want to speed, or if you want to turn in a not allowed place, then that's up to you. But you know that you're taking the risk. If you have somebody on the back seat, your kids, everyone, you take a risk also for them. If there is some car coming directly to you and you're speeding, you know that you will be responsible also for damaging others and everything. So if you have this thought in your head as a risk culture, and I think that that's the invisible risk culture, but we are striving for, and what I'm really.
Thank you very much, Mari. And I think, yes, this is not probably very easy in all of the institutions across the globe. So it might be a real challenge to put the risk culture within the overall, let's say, company's culture or company's values. Thank you. And as well to you, I will have surely some questions. Let's now introduce the last panelist we have, and that's Antonina Mackiewicz, the head of CRO office and operational risk management at Citadele Banka, based in Latvia. And Antonina will elaborate a little bit more on, let's say, the business continuity, operational risk topics, which I think is the key area of her expertise. So, Antonina, the floor is yours.
Hello, Peter, thank you for the introduction. Yes, I've been in operational risk management for almost 10 years, and I have observed the risk culture in different organizations, and had some experience about seeing different risk cultures. Our panelists already today have covered a lot of important aspects of risk culture as such. And in Citadel Bank, we believe that communication is the key, and for the risk culture, and to have a strong business continuity, to have strong resiliency, and in general, to be risk aware. It's important to communicate to employees frequently and to ensure that everyone in the organization knows what to do, whatever happens. For example, in the recent years, as already others have mentioned, they have experienced like a lot of different events: COVID pandemic, global crisis, and a war, and geopolitical tensions, and a lot of environmental disasters as well. And a lot of companies and organizations who had weaker business continuity planning or maybe weaker risk management culture had to leave the market, unfortunately. And here, when it comes to business continuity planning, if we do it just for a tick, and if we do it just within the management team, then it will not work. It's very important that everyone contributes to the business continuity planning, then that employees also are involved. And when we think about business continuity as such, we really have to imagine how would it be. And here maybe some coaching, like a good coaching would come in, that you would ask a question like, how will I communicate to other people if no communication channels are available? How employees who are not critical employees and who are not managers will find out what to do, whatever happens. So all these things, as we think through, are important to design, not just on paper, but also to blueprint in people's heads. Because when crises happen and when emergency happens, and many people are in shock condition, and this is when they cannot think what to do and what to do next. And there are a lot of questions come in. And this is the risk culture when people don't have this question in their heads, because this is a routine. This is something what we know, what to do, where to go, whom to call, and what is their role in this particular situation. But unfortunately, due to human nature, it's very often we are rushing, we have priorities, we have business to do, and these bad things, which might happen sometime and which we never experienced in the past, it's so difficult to imagine, and it's so difficult to think, so how will it be like? What will I do there? And if you have not imagined that, if you have not lived it through, then when it comes, you're not psychologically ready to accept it and to move forward. And therefore, we don't just imagine, write on paper, but we also go and test. And test, it means simulating the real situation, inviting your third parties and outsourcing providers to participate in this training, maybe even involving other market participants and involving other like regulators, for example, as well, to make sure that this communication channel works not only within your organization, but it works also outside. Because in such cases like war, you will have to think outside of your organization. And this is the strongest aspect of risk culture, which I wanted to highlight in this panel today. Thank you.
Thank you very much, Antonina. This basically, the last, your words reminded me of one story. It's very good, of course, to include the regulators into the business continuity exercises. However, it's also very good to warn them in advance, because I recall a story which happened like 10 years ago in our organization when we were testing the contingency funding plan. And one of the action steps was calling to the central bank for a liquidity injection. So once we called them, they were really frightened what is going on with the institution, and it took us some time to explain that this is just a testing exercise. So it's also very good to warn them a little bit in advance that something like that is coming, not to jeopardize the situation. Thank you very much, all colleagues who participated in the initial speeches. Now, I would probably start the discussion, and I would open the discussion with the first topic we had on the panel with Algimantas and his ESG considerations. And Algimantas, for you, I would have quite an obvious question, because there is a lot of regulation coming to banks and a lot of, let's say, regulatory texts which we need to read through, which we need to carefully let's say, take care about and implement necessary steps. So currently, I think that the ESG topic is quite costly for not only banking institutions, but probably across the industries. However, in the future, at least the regulatory texts say so, it should bring us also some benefits. So do you see, or when do you see that the financial benefits for the institution should be coming, if at all it will come?
So thanks for the question. It's really very good question. And I would say that the first of all, staying in business is the main benefit from complying with the regulations. So if you want to do banking, you need to comply with all the banking regulations. So this is already the benefit, and then I would say that it depends on the business model of the organization. So potential opportunities are funding, as there are funding possibilities for the green bonds, or let's say some international financial institutions offer fundings at good rates for the institutions that, let's say, have a compliance with certain ESG criteria. Another obvious thing is if investor relations happen for institutions, there are more and more of investors who commit to invest only in companies that fulfill certain ESG criteria. And also there is an aspect of risks, as of course it also depends on the region in which the institution operates. So for example, in Lithuania, the climate transitional risks are low, as we don't have earthquakes, we don't have major floodings. Droughts are also not a very big issue for us. But if we look at the transitional aspect, so I think that we will soon start seeing if some additional taxes on carbon or something like that, and if even some companies might even lose licenses. So it's not here now, but I would expect that in 5 years it would be very relevant. So if we are talking about lending, also another material aspect is energy consumption of the buildings, energy classes of the buildings, as that we have as a collateral. It might appear after a few years that certain collateral value has gone down because nobody wants to, let's say, buy or rent collaterals with low energy efficiency. So I think that that's the main aspects.
And also, like these provisions probably are largely coming from the top of the EU, as we are all located in the European Union. So basically, in that sense, do you see some direction in which the ESG regulation is going, and probably where it will go in the near future?
Yes, I happen to be following the regulations, the discussions, and of course there is no such complete agreement, but from what I am hearing, it is very likely, as we had the commercial banking industry tackle NPLs previously. So in the upcoming years, the whole industry will tackle non-sustainable loans. And also there might be some impacts on the, let's say, capital requirements, as currently we are in a phase of collecting data. But if, let's say, the regulator sees the increased risks, and then it's very likely that some capital add-ons will be required first as a Pillar 2 process, then maybe even included in the capital regulations as a Pillar 1 requirement.
Yeah, thank you. And I think that the largest institutions in Europe already feel the ESG topic coming into the Pillar 2. It's like, as you're a very experienced banking professional, do you see that the, let's say, other functions within banks are bought in the ESG topic in the same way as the risk management is, or is their perception probably somewhat different, heavier or lighter?
So yes, actually, from my experience in the Sustainable Action Group, so we had our marketing and communication department deeply involved in the S letter, so that's not very big news to them. We had legal department involved in the G letter, so that's also nothing. But now we're trying to involve the whole organization. So I see, let's say, the biggest lights in the eyes of product development people as we are thinking of what new lending products can be introduced as that both have an economic meaning and satisfy the regulation criteria. So
thank you. Now, as I exhausted my questions, I would ask the other panelists whether you have some question for Algimantas.
Yes, actually, you know that it's I would a bit oppose you. Say that in our region, the ESG and this environmental thing is not so crucial, because I'm in Estonia, quite close to you, in Lithuania, and we don't have snow so much anymore. It's not so cold, and it's really weird that I'm visiting Lithuania, and it's colder in Lithuania than in Finland and Estonia. So that the climate is changing, and I think that we really need to do to stop it. And it was just reported the last week that Estonia, or Baltic region actually, has the highest increase of temperature in the whole world. So that we don't have earthquakes, God forbid, but the temperature rising here is actually the highest. So and Austria needs to totally reconsider their model if they don't have snow in the mountains there. So that's yet another. I have not been this year in mountains in Austria, but there was a big media in Estonia that there is no snow in Austria. So that I think that this ESG is just getting so important now. So and reviewing all our action business models, and as this is the case of risk resilience here, so that the business model risk here is very high and needs to be reviewed.
Thanks, Maria. And I will also add, maybe it's a bit local thing, but relevant for the Baltic states, that we used to have very high energy dependency on Russia. And we see going to green energy as one of the ways to become energy independent. And our government is quite eager for this transformation, not just because of the environmental impacts, because if it is warmer, it's better for just locally us, because those cold winters are not something that most of our people like, but being independent, not depending on such neighbors like Russia, is something that we want to achieve.
Yeah, Yeah, this is very similar for the Czech Republic as well. And the ESG topic, I think, will gain on importance in the coming years. And one of the aspects next to the environmental aspect is also social, where Paula definitely has the expertise in the area of ethics, risks, and sticking to the ethical codes and codexes is one of probably the key skills we will need to maintain within the risk function in the future. However, Paul, if you think about, let's say, a future risk professional, what do you think will be the right skill set for a risk person working in risk management like 5, 10, 20 years from now?
Thank you for the question, Petr. Great question. So basically, as I shared previously, looking into the hard skills, I think the answer is quite easy here, because companies and risk and resilience teams are focusing, of course, on senior experienced, highly educated professionals. However, I would focus my answer on the soft skills, which gain a lot of power, I would say, and do make a difference upon employment or at the decision for employment. And here I would focus on the agility of the individual, adaptability, as previously mentioned, and the curiosity to learn and further develop. Having this growth mindset, which means that you continuously develop yourself, but you also develop others, and learn to improve and learn from mistakes. I would also mention here personal impact and influence without authority, because ourselves in risk functions, we do have this mission to also train others and to make this changing within the teams. Project management is also one that I noticed that you heard, and I would rather fit this one into the more hard standard set of skills. And I would add to this project management one more skills, which is the capacity to see the big picture, which is very, very important.
Yeah, indeed, it is. However, like the future skill set seems to be quite demanding for one individual. Do you think that in the future we will have enough supply from the job market to find the right people to work in risk?
Well, looking at the job market already, I do see somehow progress, even though, in my opinion, risk professionals sometimes do seem as quite rare diamonds on the market. To me, it was very hard to, and I'm sharing from my experience, very hard to find, the right individual with the right capacity, but sometimes you have to take a risk and settle with the attitude. I recently like a very shared idea that I would like also to share to you, that hire for the attitude, not for the skills, because skills can be easily learned, but the attitude does make a difference. So getting back to your question, Petru, both the market and professionals will need to adapt to meet the needs of each other, so request and demand, and the pace of the environment, and keep the rhythm here. So hopefully people and professionals will further develop themselves to get better and better, and still have this commitment and desire to work in risk.
Yeah, thank you. It seems that there is still some way to go ahead of us individually. And maybe a last point to that, do you think that let's say, individual industries will, in risk management, request a very similar skill set from the individuals, or do you think there will be some material differences, for example, between banking and pharma or other industries?
Yes, well, I do believe that risk functions are not so different in the end across the various industries, even though methodologies might differ. companies are now looking besides the professional experience and individual profile of people, also promoting this right attitude that I was saying, and I do see this often and often also being shared by my HR colleagues. So the skill set should not be so different from a professional to the other, but rather focused on this continuous adaptation and self-development, so that people, individuals can easily switch from one industry to another and share experience, because of course we can all learn from each other's from various industries and change. This is very interesting because we can exchange ideas and practices and the sharing of experience, which will be in the benefit of us all, yeah, individuals and companies.
And sharing the ideas and the experience should make us really human. And so, my dear diamonds on the panel, would you have some questions to Paula on, let's say, the skills of risk management or differences across industries?
Yeah, I just can agree with everything that Paula said, but I would add also one of the skills what we see is really important is data reading, analytics, and analytic skills. So I'm heading compliance function, and compliance function used to be a field for lawyers, but not anymore. Data, like understanding and reading the data, is so important skill. And yeah.
Thank you,
yeah.
Yeah, thank you, Mari, for sharing. Indeed, data analytics, working with big data volumes does make a difference. So basically, working on the same patterns that we used in the past proved that this is not enough. Yeah, so basically, that data and AI should be used also in our favor and in our benefit and support.
Yeah, sure. And when talking about compliance, and giving the fact that cyber criminality is rapidly growing, so the need of quick analysis of data is increasing incredibly. Thank you very much, Paula. Maybe this one, because what I've heard now from you, Paula, and from you, Mari, seems like that risk became more a partner for the other functions within the organizations, and it seems that either risks try to get closer to the business or tries to pull business to be closer to risk. Mari, do you think that this trend will continue in the future, or will there be something that will disrupt the trend and that will strictly, let's say, frame the risk out of the business?
No, I think that definitely that the risk function or second functions are getting closer to first functions, and this is like really growing trend. And also during today, we have several times mentioned that it's also our responsibility and as we as ambassadors, so that we should show the benefit of being compliant, being risk averse, being aware of our possible risk is actually like a crucial element of a business strategy. And I really can echo only, and I wrote this quote down what Algimanta said earlier, so that staying in business is the main benefit of being compliant with regulations. So this is very close to me because I'm head of compliance, but this is also like a bigger like a topic. But being aware of our risks is like this is like a crucial thing to be here at all. So as the circumstances around us are changing, if we are not flexible and adaptable, as Paula also said, so then we are not here, because things have changed a lot during the last years, and a lot is to come. Take the CSG topic. So the values of people have actually changed, and this is now pushing also companies to change. So a few years back, or 10 years back, I was never thinking that why should I change my coal oven to something else. Now I'm like having totally like I want to have a windmill doing the electricity, so I'm not buying the the regular electricity, but buying windmill electricity to heat my house. And I as Argumenta said, that I bought exactly the house what was very energy efficient, and now I'm thinking of solar panels to actually sell electricity to the state. So that's how things have changed. 10 years ago, I never thought that I would be doing things like that.
Okay, you're completely right. Let's say the shift in the perception of individual risks changed dramatically, I would say, in the last 5 years. And the shift is also visible, let's say, in the last year or two. It's like a lot of things happened, and that unfortunately influenced the landscape of risk management quite a lot. It's like now you basically worked for different companies in different, let's say, countries, and that is, I would say, very, very important experience. And getting back to the risk culture, have you experienced during your career some common features? Does not matter whether they were good or bad. Basically, both sides are quite interesting in the risk culture you saw in the companies you worked for.
I have to say that I've been reading a lot about different cultures, so it's very interesting for me how business in different countries is different, and I can really echo that Scandinavian countries are very risk-knowing, and they are very careful in taking any risks. They are like taking long discussions. They are agreeing. They want to really understand. So I would say that mainly like Sweden, Norway, Finland. Like they are all. Denmark, I'm not so much familiar with, but definitely these three countries. And then what I'm seeing in other countries, like in Estonia and Baltic countries, is that we are taking risks, but more and more we're taking risks knowingly. It used to be that we took it without like really understanding them. So I think that the awareness of risk management has increased. And that's really a good development, I think, also. But this is the culture, like overall countries and nationalities, like culture. It's very interesting how it also shows in a different risk culture. If I would go to Sweden, for example, or Finland, and say things what I'm doing, and without thinking risks, then what would be normal maybe for Estonians, then they would be like, Mari, you're crazy. Why didn't you think of the result or outcome of it? How could you do that? So and I don't say that one thing is good or bad. I'm not saying that, but I say that I see in different company cultures, also different risk cultures. But overall, the more and more, at least in the banking sector, we are now over the Europe, thanks to ECB, press into sound risk culture and also understanding what it is. And every year the threat assessment was mentioned also by Argumentas, like we get very clear feedback what is sound risk culture.
Yeah, indeed. It's like it seems to me a little bit, the differences are of course now minor, but I still feel from time to time that it depends a little bit on what side of the Iron Curtain you were like 30, 40 years ago. And I still feel that we, like in the last decades, were gaining the Western experience. Do you think that this is common for all, let's say, those countries which were in the, let's say, Soviet-controlled region?
Yes, I personally think so. Yes, and I think that it's kind of like nothing to do with Soviet, because I'm too young to kind of like remember that. But what I see when I compare the old Europe with this new Europe, that we are more flexible, we take more risks, and we are moving much faster. So, but now, I said that 30 years have passed from this time when the Soviet Union collapsed. So now that the speed is getting also lower, and we are more aware of the risks, and we're taking it into account. And we are here. We start to understand that we are here a long time. So we are not here only a short time. So I do my things today, and tomorrow I might die. because there are like corrupt politicians, there are like shootings on streets, whatever. So we are taking a longer perspective, and that's why ESG is coming also like really important, not for old Europe, let's call it like that, but also for us and our new generation, definitely like the same as all Europe. I don't see actually any difference.
Thank you very much, Mari. It's like colleagues on the panel, do you have some questions to Mari?
I would have a question, Petru, if I may. Mari, what do you think is the key element from your perspective that might generate a switch in perception towards how the risk function is perceived by organizations?
So seen by?
Is perceived within the organizations, perceived by the business and within the organization as a whole.
Mm-hmm. Yes, right now we are perceived more as a controllers. So and this I think is something what needs to be like we need to move closer to them. Of course, we have a control function, what we need to have, because we are the insurance providers for the management that things are right and that the business is flourishing. Let's say also that something unexpected cannot happen. But that's like I definitely think that to explain our processes, to why we need to do every year this terrible risk self-assessment process. We hate it. So, but then you show really the benefit of it. So, and in case of COVID or whatever unpredictable risk but occurs, you will like harvest the fruit here. So, and as currently or recently there have been so many these risk situations, the war, the natural disasters, the COVID, then I think that we at the second line have actually received a lot of credit that we have done a good job. And now they also respect our voice more. But we shouldn't overdo it. We should be very like practical and sensible of doing our things.
Yeah, thank you. It's like the perception is definitely changing in time, and let's say the perception of the risk function within the organization is very, very important within the management of especially operational risks, because like the operational risks, I would say, are really, really connected to the risk culture. Maybe Antonina, as you are the op risk and business, let's say, continuity expert, do you see it's let's say similarly? That means that the cooperation currently with the other functions within the banks, either in managing operational risks or during the business continuity planning, testing, and all those exercises, is more smooth, or do you think that it did not change at all?
Well, I think the entire perception is changing, yes, because previously it was mainly like a regulatory burden, and now it has become like enabling a business. So the risk managers also have already changed their mindset in terms of thinking how to perform risk management in such a way that it brings value and not only stays on paper. And it's never been smooth. And it's always a challenge to sell the benefits. And as I started with business continuity, the starting point where we start to just analyze the processes, and everyone thinks that they're very critical and everyone considers themselves very, very critical. But then it comes to preparing a business continuity plan, it becomes like a challenge, what to write there, what's important, how to build it. And that's where these enablings come in, and when we imagine and when we play the war games and play the simulations and then sit down and think, so what did we learn? How can we like apply this learning into practice? And what also I have found is when organizations are technologically savvy, so they understand how their processes are like connected with systems, and how their systems are enabling the processes, then it's always easier to plan, and then it's also always easier to manage the risk. It becomes smoother then.
Thank you very much. And regarding the systems, when talking about them, it's like I remember the operational risk management and business continuity was heavily work with people like 10 or 5 years ago. Do you feel that, let's say, the data, and that means the importance of the data and work with the data and the analytics is now gaining on importance in the area of risk and business continuity?
Yes, for sure. Data management and data governance in general has become a huge priority also for our bank at this moment, and it's one of our key focus areas at this moment in operational risk management, because utilizing the data, it firstly helps to automate and helps to become more efficient, and it helps to really see where we should focus, because without being data savvy, it's not possible to be pretty efficient, and it's not possible to see, to forecast the risks which could be upcoming, and it's not possible actually to see where we are doing wrong and where we are doing right. So yes, of course.
Yeah. It's important to know the landscape, right, and to understand it, to be able to analyze the data. And Algimantas, I see you raising your hand probably.
Yeah, I wanted just to add that another important aspect of continuity planning is testing, because on paper and on the models, everything can look one way, and in reality, there can appear that something was missed, and it although nice on paper but does not work. So I highly encourage to do testing whenever it is possible.
Yeah, so sourcing your data, testing, getting the lessons learned, and thinking about enabling, not blocking, these probably are these key things.
Yeah, that's correct. That's correct. I feel that as well. And maybe Antonina, another question linked to that. How do you also see the regulatory requirements in this area? Because it's like the regulatory provisions that were focusing on different areas. And I think that the CRR2 was not that much focused on operational risk. Is this changing? And is the regulation of op risk and business continuity now increasing?
Yes, the regulatory requirements are becoming more stricter and wider and broader. And in Baltics also, we have additional regulatory requirements now with regards to national security and military threats. So Baltic countries are preparing also of that, and this is a regulatory requirement to actually have a market practice for resiliency in war, to test actually business continuity together with military forces and together with national like ministries and the central bank. And we are having like once a year these exercises, and the regulatory requirements are becoming more and more stricter, not only from local regulators, but also from the ECB.
Thank you very much. Thank you. And as we have currently only a few minutes left in on the panel, and as I see there are some questions coming to the chat, I would now turn to the chat, and over there we have a question for our Algimantas. So the question reads that whether you have more relaxed eligibility criteria if the collateral fulfills energy criteria. For example, lower haircut on its value or more flexible LTV calculations?
So actually, we have some, but it's, you know, as we are still in the process of collecting data as the whole world, so we need to make some expert judgments, and therefore not that much of a haircut, but let's say for the we have loans for the houses with A+ energy certificates. So we apply some expert-based judgmental haircuts.
Yeah, I see. The green products are only coming, right? Yeah, that's true. And the second question would be, and that would be probably to all of you. So I would ask you if you can be brief, each of you. Do you provide any trainings to your employees to fast track careers in risk?
So I will start because as previously in the panel it was mentioned that you have to have the right attitude and you can train on the skills. So I fully agree, and we are also working to have more comprehensive training programs for our staff.
Thank you. Paula?
Yes, basically we do have not just related to risk, but to any other function in the organization. We have some career path systems which you aim to direct individuals and match individuals having certain skills to certain roles. We do have some, but this is very recently a tool in place. Exactly, this is the name matching platform that matches your skills depending to a predefined set of questionnaires and data that you are sharing about yourself and your interest towards the role, so you might be able to reach and how to be trained in that perspective.
Thank you. Mari, would you like to add something?
Yeah, I think that it's actually really important that people have a visibility where they could grow. And I'm totally, and our company is also totally for this the growth mindset type of thing, so that you can see that you can grow from business to risk area, and also you can grow inside the risk area, but also outside back to the business area, so that all these paths are open, and we discuss it yearly with our employees, and also provide support and mentorship if somebody wants to change from business to risk from business, so that as Paula said, like the people are diamonds, so that we definitely want them also to grow and hope that they might come back one day to our risk side, so that having more experience from different business areas and having insights, so it's important.
Thank you indeed. And we will close this panel with Antonina, the her view.
Yes, same for us. And in operational risk, we are fast tracking employees with more trainings on information security, on IT risk management, and on data risk management. So these are our fast tracking risk career sort of for our employees, so that they can also choose their focus areas which kind of risk and non-financial risk they want to manage.
Many thanks to all of you. I think we have exhausted our time. So once again, big thanks to panelists, big thanks to the audience raising questions. And very last word of mine would be that our CEO's view is that diamonds are created under pressure. With that, I wish you not that much of the pressure, and great progress in your careers, and I hope to meet with you in the future. Dear ladies and gentlemen, with this we are finishing the panel, and we wish you a very great rest of this event. Thank you. Goodbye.
Thank you.
A huge thanks to everyone for this very interesting panel, and I would like to announce you a keynote presentation which is made by Paula Mihaescu. The presentation called is a country ethics, risk and compliance. Oh, integrated risk management system, the power of evolution. Stage is yours, Paula.
Thank you, Destan. Hello, everyone. So thank you for the introduction and welcome everyone to this session. I will now start projecting my screen, and I will need some feedback from you, Destan, once my screen is visible.
Sorry, could you repeat again?
Can you tell me
I can
my
see.
screen is now
yes,
sharing?
I can see.
Okay,
Everything works well.
Great. So hello and thank you again. So today I'll be talking about the integrated risk management system. and how these underpin the evolution and growth of companies and foster further success. My name is Paula Mihaescu, and I'm Country Ethics, Risk and Compliance Head in Novartis, Romania, based in Bucharest now. Novartis is a Swiss pharmaceutical company with roots traced more than 250 years ago, focused on reimagining medicines to improve people's lives. It is a large group in Romania formed of many divisions such as oncology, a pharmaceutical division, Sandoz, which covers biosimilars and generics, and the factory, the producer as well. Now, looking into our agenda today, I will be presenting a short introduction about Novartis. Then we'll talk briefly about the Ethics, Risk and Compliance program, diving into the integrated risk management system, showing how this management risk function is aimed to partner with the business and foster together as a team evolution. Briefly on our company profile. As I mentioned, we are a medicines company with headquarters in Basel, Switzerland. Novartis is focused on patent treatment in multiple disease areas, including cancer and rare diseases, to enhance health outcomes for patients and offer solutions to healthcare providers. Our research and development teams and the department is basically the heart of our company. It's the innovation engine of Novartis, focusing on discovering new drugs that change the practice in medicines. Operations and everything relating to how systems are run relate to a network of 60 manufacturing sites worldwide. And this department is responsible for making innovative medicines, devices, and Sandoz products, delivering them to our customers across the world. It also consolidates the support services across our organization. They drive efficiency, simplification, standardization, and quality processes. Global functions here, where also my ethics, risk, and compliance function sits in, supports the enterprise in the specific areas of expertise, including finance, legal, communications, human resources. Sandoz, which I was telling you earlier that it's another division of our company, offers patients and healthcare systems high quality of generics and biosimilars. When it comes to our strategy, we aim to deliver high-value medicines that alleviate society's greatest disease burden through technology leadership in research and development and novel access approaches. As we execute our strategy, we have a clear focus, areas that determine where we invest our time and our money. We have significantly increased our focus when it comes to 5 core therapeutic areas, technology platforms, and priority geographies. Looking into priority geographies, we are focused on US market, China, Japan, and Germany, while our products are being sold in more than 155 countries. Our vision is to become the most trusted medicine company in the world. We believe that the greatest strength at Novartis is our people, whose diversity, energy, creativity are crucial for our success. We continue to build our culture based on core values like inspired, being curious, unbossed, and all of these being underpinned by integrity. Our products address major diseases areas and are sold throughout the world. We focus on therapeutic areas where there is a significant disease burden, where people are suffering, and where we can build a stronger and more independent position. We've moved from working on more than 10 therapeutic areas and 50 disease areas to focusing now to 5 therapeutic areas and around 20 disease areas. These 5 core therapeutic areas are cardiovascular diseases, immunology, neuroscience, solid tumors, and hematology. These 2 cover basically cancer treatments. When it comes to our impact, we are driven by a strong sense of purpose and being inspired and inspiring others to make a difference. Our work can change the course of millions and millions of individual lives. 743 million last year, for example, patients that were treated with Novartis drugs. In terms of net sales, 50.5 billion. It's both a tremendous responsibility, but also an incredible privilege. Looking into our ERC strategy and program, getting closer to the risk management topic now. Our ERC comes again from ethics, risk, and compliance. I will be using this acronym along my presentation. The ERC function support is provided across our organization and corporate functions, having more than 600 associates globally. Our corporate ERC teams cover ethics and compliance, risk and resilience, Speak Up Office, which is our whistleblowing line and related team, data privacy, digital and AI compliance. We support Novartis and its associates to act ethically and to reliably achieve our objectives. Our strategy in ERC covers ethics, risk, and compliance. By creating one ERC function, we have coordinated an approach that people can now know and operate more effectively with ethical dilemmas, approach enterprise risk management, and manage compliance regarding regulatory both internal and external requirements. ERC is a function that now is perceived and acts within the organization more like a business partner, an enabler, rather than a policeman. Our ERC program consists in the 3 main pillars that I will further discuss, and includes our top priorities for 2023, which are looking into building a more sustainable foundation on ethics, human rights, Speak Up, enterprise risk management, health and safety, emergency management, compliance risk management and policies, training, communications, review, and monitoring and mediation. Looking closer now into the risk management system, let's see how our risk management system looks like and how it is defined. Starting a bit top-down, let's say, approach, we are looking into behavior science, data science, and decision science. These all 3 help us better identify and manage risks. It's not just about identifying few risks or some bad apples within the organization that might misconduct or pose some threats. It's about supporting the all other associates to do what's right and to empower them to identify and address their own risks, to teach them how to do this. So in order to achieve this, our ERC function is anchored in our program of science. Behavior science is about understanding what drives and helps us focus on what matters. And with this insight, we can further shape our internal environment to support ethical decision-making process. Data science is about generating insights and extracts that we might use from our available data. And decision science is about transforming this data science that we collected into actions. Data scientists take care of the data analytics, while decision scientists handle the business context by converting data into context specifics, objectives, insights that can promote better and speedy decision-making process within the organization. Our integrated risk management process is aligned with our policies and controls to our enterprise risks. IRM covers risks, policies and guidelines, internal controls. An effective risk management system is integrated within the business. It cannot work separately. And this focuses on clear accountabilities of and responsibilities of business owners and business units in order to identify their own risks and mitigating plans, and of course, put them into action. This is done following clear policies and guidelines supported by training programs. The policies are interconnected with the internal controls and are embedded into the business processes and ensure that risks are mitigating. So keywords here, clear accountabilities and responsibilities, improved governance and oversight, and harmonized methodology so that the business can manage risk more effectively. Now, looking into the risk assessment process, this is a process that we conduct locally. Actually, countrywide, I'm responsible of managing this process. It's only part of our risk management process. And this is done again periodically and at local level. All risk assessment management processes are conducted by local ERC together with the local management team and the relevant business owners. This includes several phases, a scoping a period that is concluded with the risk assessment meeting, where following the completion of some questionnaires, predefined set of questions, the local board answers in advance, followed by a meeting where we discuss and debate the results of the risk, collective risk scores, and then we align on the mitigating action. Once risk levels are established for the current year, this is followed by a testing and monitoring phase on each risk area. Once the tests are completed, results are also reported into the management final review meeting, which happens sometime toward the last quarter of the year. And then remediation and mitigation activities are performed. While this is a continuous review process, so basically it never ends. We are continuously looking into our risks. Like most risk assessment processes, the risk assessment requires a risk rating and likelihood and potential impacts independently of each other, with a predefined and consistent scale considering the most probably worst case under realistic and current conditions. This means that risks should be assessed in the current risk, the most likely impact and likelihood scenario, considering the current controls that the organization has in place and are operating effectively. Looking into our risk appetite, this is defined as the amount of risk that you are willing to take in reaching your objectives, and it reflects the risk management attitude. In turn, it influences its culture, operating style, and decision-making process. Depending on the nature of the risk and its resulting rating, our framework has defined the response considering the risk appetite in creating value or protecting value for our shareholders. And for each of these actions, a specific risk treatment corresponds, very similar to what in our risk management methodologies we find under the acronym of TARA. I'm sure most of you know TARA model: transfer, accept, reduce, or avoid. Novartis Enterprise Risk Management is the process that we manage risk at Novartis. The ERM framework is designed to generate a holistic view over the risk for the company and drive a culture of smart risk-taking. While our code of ethics sets the ethical framework for all the employees to manage risk across the business, risk management is a fundamental more leadership responsibility that involves active engagement by leaders at each stage of the process. Our ERM framework is aligned with our strategic planning, and it helps us better understand our overall level of risk exposure. The Risk and Resilience team conducts risk assessment workshops and collaborates with all the risk assurance functions to identify risks across the company. Each Novartis unit organizes a focused risks workshop at leadership level, and in parallel, risk workshops are held in our largest markets by revenue and in certain focus markets. A fit-for-purpose approach to integrating risk assurance begins and ends with understanding the business drivers that preserve and enhance the organizational value. Every organization has a unique set of value drivers. Each will have unique ways of defining, assessing, tracking, and addressing risks, and a unique set of processes for providing assurance. Once a risk is assessed, we decide how to treat it based on our risk appetite. Effective risk management requires the development and implementation of mitigation actions, which must be monitored on a regular basis. And we are reassessed, we go back basically to risk evaluation in case they are changing in the risk situation. Novartis Risk Compass ensures a clear mapping of enterprise risk, enabling focus and prioritization. The outcomes of these workshops are consolidated into the Risk Novartis Compass, which groups risks into 3 major categories: strategic, operational, and emerging risks. The Risk Compass helps senior management and our board of directors to focus the discussions on the key risks and align strategy with risk exposure. And we regularly monitor risks and revise our assessments if necessary. Strategic risks help us deep diving basically in Novartis' ability to execute its strategy or to achieve business objectives, while the operational ones are resulting from inadequate or failed internal control processes or system or employees who might miss conduct or perform errors. And emerging risks are identified as being those which require close monitoring, which may evolve to operational or strategic risk. We also keep a track of our awareness topics, which are more like trending topics, not accounted for by our internal risk management system yet, but have the potential to become and to develop into a risk, and this is why we are closely looking into it. Our integrated risk management approach include assessment, mitigation, monitoring and review, and continuous control. Our risk management framework ensures providing assurance to our shareholders and the company. This implies an overview on both external environment and internal through own team. Sometimes this is done, depending on the case, this is done by our internal teams, such as internal auditors or internal global monitoring teams or own ERC functions, which also has some responsibilities in this respect, or is done by external reviewers or auditors on various aspects such as third-party, anti-bribery audits, health and safety, due diligence, and others. Our integrated risk management system also includes a third-party risk management, which implies that we not only conduct assessments for our internal processes, but we also look and have a closer look on the business conduct of our third parties that we engage with, and ensure that these ones are also aligned with our ethical standards. Third parties for us means suppliers, distributors, wholesalers, business development deals, M&As that go through a very thorough due diligence process and assessment process, covering multiple areas, resulting in some commitments for them. Business continuity management and Novartis emergency management are also part of our integrated risk management system. They ensure resilience through unforeseen disruptions and crises. They include a clear framework of being prepared and knowing what to do and how to respond in case of crisis, determining how and what is the potential impact through business impact analysis. Business continuity management identifies potential threats and corresponding response measures, while Novartis emergency management has defined roles for incident management at all NEM tiers, which are global, country, site level, yes, so multiple layer teams, and considered current events like geopolitical, pandemics, so on and so forth. Activation of these plans, because it's of course not just being prepared, but also knowing when to activate in order to speedily recover your processes. Consider the fact that there are certain predefined prioritized activities within the specified time frame and aims to shorten the period of disruption, providing a clear and rapid actions to achieve the strategic aim by minimizing the impact of the incident, and a periodical review and practice to ensure the exercise is still adequate and relevant. So performing simulations on a regular basis does help for the organization to be prepared and every function to know what it has to do at a certain moment in time. To conclude, having a robust risk management culture means taking a proactive stance on compliance and risks. This will support the risk errors and the risk of misconduct by also underpinning and supporting a stronger reputation. By having automated and integrated systems in place, risk management tools, AIs in your favor and working for you in your support, encompassed by a strong, experienced professional with the right attitude, individuals and professionals working in ERC, which are curious, adaptable, agile to the changing environment, will turn data into knowledge faster for real-time decisions and data-driven decision-making, ensuring the continuous power of our organization and having and being more ready for tomorrow. And with this, I am now finishing my presentation, looking for some questions from you.
Thank you, Paula. And there are no questions from the audience.
Thank you.
Thank you. Thank you for this presentation. It was very interesting to listen to you. And dear viewers, now we're going to have a short break. And after that, we will have a module called Risk Data. We will be back at 3:15. Enjoy the break and see you all soon. Hello, ladies and gentlemen. The final module number 4 is called Risk Data and will focus on the role of data in modern risk management with the panel discussion, which is called Data-Driven Risk Approach in Digital World. The discussion will be moderated by Marko Rodic, Head of Lending in RBA Banka. Hello, Marko. Thanks for connecting, and the stage is yours.
Hello to everybody. Thank you for inviting me to this panel. My name is Marko Rodic. I'm Head of Lending in RBA Bank, member of Raiffeisen. I'm 15 years in the banking industry, in risk management, in underwriting, and significant part of my career I was in Credit Agricole Bank. Now I'm with Raiffeisen. So I will be the host of the panel, which is very interesting. And before we start, I would like to say thank you thanks Connectiva for organizing this event. The topics are very interesting. So I hope that this last topic for today will also be very interesting for everybody and that we will exchange a lot of interesting information. So I would like to start first and to introduce the panelists. So ladies first, Elma Agić-Šabeta, sorry, the Risk Control Director from Bosna Bank International. Elma, can you give us a little bit more information about you?
So since 2002, I am active in the banking sector. First, I worked at HVB Bank, which was a daughter company of HVB Bank from Munich in that period, and that later on merged with UniCredit. Then I moved, I was mostly engaged in controlling and accounting division, working on transformation of banks and integration of banks in Bosnia and Herzegovina. Later on, I moved to Bosna Bank International, where I worked in controlling, project management, and finally, risk control division. Besides that, I also worked at university as a lecturer in money and banking. And I am also very interested in topic of ESG, and have been engaged in some studies in this segment.
Okay, thank you. From insurance business, we have Miroslav Šalša. Miroslav.
Hello, nice to see you all, guys. So my name is Miroslav Šalša. I am working as Chief Risk Officer of BNP Paribas Cardiff, Central Europe. I started my career in insurance industry more than 50 years ago as an actuary, which is, let's say, quantitative-oriented guy or mathematician working on the definition of insurance premium rates and calculating technical reserves, capital management, very close cooperating with the business and also with the financial departments. I moved to the risk area in 2016 when insurance industry adopted a new regulation, which is called Solvency II. This is something which is heavily inspired by the banking Basel regulations. And this regulation, let's say, increased the significance and the footprint of the risk management in the insurance business. So this was for me the time to decide to a little bit change the job. And that's, I think, more or less everything. I'm more like coming from this quantitative work, so especially focused for the underwriting, risk management, capital management, and things like that.
Thank you. And from Moneta Money Bank, we have Peter Toman.
Hello, everyone. Thank you for having me. So I'm with Moneta already for 12 years. I worked the whole life in risk management in different areas. Right now, I'm responsible for collateral management, commercial workout, portfolio management, and I also serve as a chief risk officer of our subsidiary here in Czech Republic called Moneta Building Savings. Thank you.
Thank you. And Radomir Dukovic comes from Bulgarian Development Bank. We don't hear you, Radomir. We still don't hear you.
Now? Can you hear me now?
Yes, now it's good.
Oh, I'm sorry. This is from the connection. I'm currently Chief Compliance Officer at Bulgarian Development Bank, For the last 15 years, I've been working in the banking sector, more than 14 of them in Raiffeisen, where I was responsible for the risk management, fraud risk, operational risk, money laundering, sanctions, anti-bribery and corruption, FATCA CRS, conflict of interest, and all compliance topics were covered by my team. So this is in a nutshell.
Thank you. Well, I would like to start with the first topic, regarding the digital transformation and data-driven risk management. We cannot avoid fact that with this digital development, we are losing the personal contact. When we are talking about internal procedures within our companies, this digital transformation increase the efficiency on one side, decrease possibility for operational mistakes. But when we are talking about outside and the communication with the client, this fact that we are losing the personal contact and that we do not see the client anymore, but we are seeing the information which we gave from some big database about the client, is this situation increase the risk? And what is your opinion about it? And I would like to start with Miroslav and Peter. Miroslav for the start, because you're coming from the Central Europe, where this digital transformation is more advanced rather than we have here in the Balkan region. So can you share us the experience? Do we take more risk with this digital transformation, or it's balanced and under control?
Okay, thank you. So my opinion is that if we are talking, for example, as an insurance company for, let's say, traditional insurance risks, I don't think so that somehow this situation of not seeing the customer face-to-face increase somehow our risks, because all necessary informations are already obtained to our, let's say, systems, and we can verify a lot of informations about the customers. So, for example, his age, address, and things like this when we are discussing, let's say, his insurance policy. Still, it is an insurance company who is actively making the underwriting process as such. So for me, it doesn't matter if, for example, if there is a life insurance policy and if a customer is filling up some paper and some medical questionnaire, or if this medical questionnaire is filled during the digital channel. So for me here, there is like no difference. And for also, let's say, the digital underwriting process start to be quite relevant also for non-life insurance industries, for example, car insurance. Here, on one side, the risk could be maybe bigger because, for example, if you are going to insure the car, there is like nobody who sees this car physically. But on the other side, we have new technologies which are supporting us and helping us to mitigate these risks. So, for example, today, if you want to make an insurance policy for the car, liability insurance and damage insurance through the digital, still on the side of insurance company, the customer provides you a lot of personal data and data about the car. You can verify it with some registers, national register. So the information about the car as such is there is no space, I think, for the fraud. And for example, then for customers sends us some photo documentations. And again, you have some artificial intelligence, you have some algorithms and methodologies behind that based on the photo documentations, we are able to assess, let's say, the risk, the quality of the car. So personally, I don't think so that this is a huge problem from that perspective. Maybe from compliance processes, the fact that we don't see the customer face-to-face, there could be something, but let's say from traditional, let's say, insurance risks and insurance perspective, I don't see that this is something which increases our risks. Maybe in some cases, this is important. For me, it's a possibility how to reduce some regulatory risks, especially related to the distribution of insurance product, because at European Union level, there are, let's say, quite strict regulations how the insurance product should be distributed. What is the amount of information which has to be provided to customer? That customer has to somehow verify that he obtained and received all those documents. And this is honestly much more easier through digital channel than if you rely on persons, because they can mislead the client, maybe they can forget to provide some information to them and something like that. So personally, for me, toward the regulation, the risk of mis-selling through the digital channel is lower compared to, let's say, traditional distribution through the agents and through POS.
Thank you. Thank you very much. And Peter, what is the situation regarding the bank?
Yeah, so here in our bank, and then I will be more general, I think that the risk is not did not increase. And the reason why is, I think, because we have quite sensible approach to the changes we are doing. So we are not focusing or we are not trying to be digital at all once, but we are focusing on different segments. So we started with the retail unsecured lending, where I think to go digital is the most easier from all the segments I will be talking about, simply because you are not lending too big amounts, and also you're able to get from the customer, from his personal ID or driving license, the necessary information, which is then accompanied with the information from the registers, etc., to basically do at least some basic credit scoring. And if you have sufficient collections process behind, depends on the level of risk you are taking, then I believe that overall the credit risk position of the bank would not deteriorate. Different situation would be in the retail secured lending, where obviously if you have a pledge in place, it requires much more scrutiny about the check of the client. So there, the approach needs to be much more sensible than in the retail unsecured. And the last segment, which we are also trying to digitize, and it's not an easy one, is a commercial segment, where again, secured versus unsecured lending. In the unsecured one, it's again easier, which is not a surprise, but still much more tough than in retail space, because obviously you need to also verify the source of income of the customer. And for that, you can have various inputs. So you need to have in place good enough of analytics to ensure that whatever input you have from the customer actually makes sense. And for commercial secured, this is, at least in our bank, but also overall in the Czech market, so far something where no one wants to go heavily, because to have a digital lending for big tickets, then, you know, also from the customer perspective, I think that this is not expected. So if I summarize it, I believe that in case you have a sensible approach and you are developing all connected all connected processes together, which is the origination process, scoring process, but also the collections process behind, you have sufficient staffing and you have sufficient amount of external data which you can analyze, then I believe that with even fully digital, you cannot make a mistake.
And can you tell us, can you share the information in your bank? What is the percentage of production in this part which you mentioned that is fully digital?
Yeah. Well, in our case, because just to give you the picture, we used to be a bank which was basically without a digital process, and we transformed to digital in the last 3-4 years. So we have right now 3 sales channels: digital, internal sales network, and we are still also working with the third-party distribution. So right now the digital in the retail unsecured is around 50-60%. In the retail secured, it's gonna be around 5 to 10%. However, it's mostly because the market is very slow. When the market was hot, we used to have even 20% digital origination in mortgages. And in commercial, in the unsecured, which is very small entrepreneurs, there we are like at 35% digital and 65 the rest of the origination processes.
And the quality of this production, it is in line with the other channel?
It's in line with the other channels. And if not, we are either trying to mitigate the risk with by higher pricing, or we are just working with our scoring models, and we are not allowing the bad customers.
Thanks a lot. Elma, what is the situation in the Balkan? We are preparing to step more regarding digitalization. So can you share the view, what is the situation in Bosnia and what you are preparing for, considering what you heard from Miroslav and Peter? We don't hear you.
Okay, so we are unfortunately still in stone age when it comes to digitalization in the segments of lending and deposits. A few years ago, a certain regulatory framework was brought, and there are some providers. The main problem is actually with the digital signatures, which have not been implemented yet. Regulatory framework is there, as I said, but it is not in use. And the only digital services that we use are actually referring to payment, electronic banking and mobile banking, which is going actually very well. But for loans and deposits, customers have to come to the bank, and even also for all other services, they have to first come to the bank in order to get a contract with the bank and so on. I'm very happy to hear that that there is no increase of risk for digital banking products from Czech Republic, as I understood. What is in general, or what can be said about the market in Bosnia is that, for instance, the default, the NPL rates for mortgage lending for home finance are actually 3 times less than consumer finance loans. So this is something that is related to collaterals and to in general, research studies shows that people spend money much easier when they do it with a banking card than when they pay with cash. We have all heard about that. So that's why I'm actually very happy to hear that there was no significant increase of risk in these countries when digital banking services are used.
Thanks. And when we talk about the digital, also, of course, the main point which raised the red lights, it's the compliance issue. So Radomir, can you share your view, because the compliance, this is your expertise?
Yes, I can share my expertise. So the digital transformation is something good for everybody from the compliance perspective. It brings it with its risk. For sure, you don't see the customer. First of all, this is the fraud risk, the credit fraud risk. Currently, if I can give you an example, in Raiffeisen Bank, in my previous role per year, the branches, because of the suspicious behavior of the customer, they rejected more than $500,000 or even 600,000 euro per year. If we're going totally digital, these customers, they do not visit the branch. So this suspicious behavior cannot be a catch if you don't have the proper system. For example, in the other risk, this is the money laundering risk. We see the EBA requirements, FATF recommendation for the digital onboarding. For sure, it will be easier to open a money mule account digitally without seeing the customer. But here comes the data and the proper system and even artificial intelligence to analyze the customer, its behavior, to catch it up, because you cannot stop the digitalization because of the compliance, and compliance should adapt to the new situation. This is how I see it.
Does the compliance can adapt so fast to the technological needs?
No, unfortunately, the focus is always on the business side. So when you invest so much money to the business side, you should be really careful, because you need to catch up the whole customer journey. You cannot invest everything in front without investing at the back when you need to secure. You invest, when you lose the money, you see that you missed something in the back. So the compliance digitalization should go hand to hand with business.
And what can you give us some examples? Because I believe when we exchange the examples, this will be something the most interesting for all connected colleagues to hear. What are the biggest problems you faced during this process of digitalization which you involved?
I can give you an example from my previous role. We should have built a digital end-to-end lending process with digital customer acquisition after that.
We are losing you. I think that you are pressuring the mute or something like that.
Sorry, can you hear me now?
And now we can hear you, yes.
Yes, when we built the digital lending process, we needed the data. That is why we buy the data from external providers, and then we build a totally new fraud scorecard, which are applying for the digital process. Without this, we were going to lose lots of money because we are not able to catch a digital application with the manual scorecard rules, for example. So it is challenging, and you need to think several steps forward from the compliance point of view and to respond to the request of the business.
Thanks, Elma. You mentioned the problems. If you compared with this, what Radomir just mentioned, there is a problem regarding the process of introduction of technological innovation. But what you mentioned, it's one problem before, and this is how to introduce technological culture to the consumers on one side, and to how to push the regulator to give you the regulations which will allow the technological development. So do you think that there is a way how this can be, let's say, pushed a little bit forward, or is there any chance that some new regulations are announced which will help situation in Bosnia regarding the technology, and what to do regarding the education of the consumers to go more digital?
Oh, these are very tough questions. It all depends on the mentality of people that are slow in taking new habits and changing their behavior. In general, regulatory framework in the Balkans is made by political leaders and by institutions, and they do that based on pressure from the public and based on pressure from international roles. So if there is no pressure from local institutions, from local people, then they would not do it. So the digitalization is something actually that is that's something that has to be done not only in banking but in all other segments, and this goes very slow. So in all these countries.
Yeah, so it's the global development what we need.
Yeah. So all these reforms that are taking place in our societies include also the digital agenda. So it's actually business and banks that have to become more united and put pressure on institutions to bring all necessary laws and legal framework in order to improve the business climate, environment, and so on. So I think we have still a long way to go, but the time is running, and many changes have taken place already. So it is only a question of time of how quickly this will come to our countries. Thank you.
Peter, you mentioned that you have 50 to 60% of unsecured production go digital. Can you, this is quite big participation. Can you share with us what are the biggest problems which you faced, or the biggest risk which you faced during the establishment of this type of process, which bears the risk which is under control? So just to help us to avoid, to make our life easier in the future when we try to do the same thing.
I think that it's mostly about the data and about the fact that you can verify the data which you obtain from the customer. That would be point number one. And then also authentication of the customer, and make sure that, for example, the IDs you are receiving are the real IDs of the real person, etc. So for that, we are using artificial intelligence, where basically the customer shows from different angles his face, and by that we can make sure that the person and the ID are actually connected. But this is more on the compliance side. But regarding the risk management, It's about the data and about the fact whether you can have a robust enough scoring engine. So what we need to have is basically at least, let's say, 10 to 12 fields from the customer, but the customer is not always able to provide us with all the fields. So that's basically the biggest problem which we need to overcome, the need of the risk management to have a robust enough scoring engine and the ability of the customer to provide us with sufficient level of information. And yeah, people are usually lazy, so that then you have a problem, because you cannot go fully digital. You still need to have sufficient public presence with branches, and obviously it costs a lot of money to keep both channels. So really, it's this kind of a mix which we need to carefully assess and adjust. And this is probably the biggest problem, because yeah, as always, money are the problem.
Thanks a lot. And Miroslav, regarding the insurance, what was the biggest problems which you met regarding this topic in insurance business, in digitalization of insurance business?
Yes, I think that one part is more or less the same what Peter said, the thing about the data systems, adaptations, and things like that. Of course, this is also connected with some project management issues, because to make this transformation also internally, you have to deal with these projects, which are usually quite big and generates all those like typical risks, I think, connected to the big projects, that sometimes they are more costly than you expected. Sometimes you see that finally at some stage of project, you have to adjust and so on. What I would maybe point out also was the HR dimension, because this transformation also internal needs, I think, that you need to bring the new, let's say, different skill set into the company. So there are also like new profile of experts focusing on digital customer journey to designing all those processes. And this was like something like, honestly, before this big, let's say, revolution in digital, we had no. So to search for these people, for example, for competitive market, like with the Czech Republic, where national unemployment rate is around 3%. And for example, in Prague, in the capital city, especially in IT sector, it's almost zero. This is something, let's say, this is the area where we had some challenge, and it's always one of our, let's say, top thing to deal with HR. And also, as Peter said, that people are sometimes lazy, and also in general, they don't want to, let's say, transform. And the change is also something, the change management, it's also something you have to manage. Yes, we had to ourselves to learn to be more like open, adaptive, and so on, because of course you have to change yourself. But I would especially point out these project management issues and HR, especially on very competitive labor markets.
Thanks. And you and Peter mentioned this thing which cannot be avoided when we're talking about this technology advance, and this is the IT part that you have said. Zero unemployment rate in IT, and any digital transformation needs strong involvement of IT companies, internal IT resources, fintechs, etc., etc. So the question for insurance companies and for the banks, but I would like to hear further point of view regarding the insurance business. How independent the insurance business now becomes or stays, if we see how big influence of IT support, IT companies, fintech, etc., and how much we depending from them regarding whatever we want to do. So do we losing the business independent, or we are still keeping it in our hands?
Well, this is a complicated question in terms that at the end of the day, you will still depend on IT people, and on one side, they can be internal guys, which creates some positives and negatives, or you are also depending on this, let's say, fintechs. So I think that anyway, let's say the dependency on the IT, doesn't matter if internal or external grew. Of course, in our company, and I think that this is maybe kind of optimal that we are using some hybrid, because we cannot manage the whole transformation just with the internal company, because otherwise we would have to transform ourselves to be IT company, and this is like not possible. So there is some, let's say, hybrid or combinations between internal and external. And let's say the ability to keep the know-how and let's say the codes and all those things at our side, and to not to share everything with all those fintechs. Yes, this is big thing. Of course, we lost, I think, a little bit the independence, but somehow I think it's for me part of the game, and that's it. But it's very difficult question, and it's something we are discussing almost on monthly basis. When we are still discussing these issues connected with the IT providers and all those things. Yeah.
Thanks, Peter. You raised the hand, so.
Yeah, no, I just wanted to elaborate on what Miroslav mentioned on the labor market, because maybe just a heads up for those markets where it's going to be IT was somehow used for running the business, running the show, but it was not so labor intensive. But then a lot of fintech companies came. They started to develop all these fancy things and employ all the talented people, and they actually paid a significant amount of money. And then it started to reverse also on the banking sector or insurance sector, basically for the employers, because all the IT people, they heard the stories about the fintech guys earning twice, 3 times much as the people in the IT in the organization, and everyone started either to challenge you, give me the amount of money I think is on the market, or I will leave and go to the fintech. And with this circle, like within 2-3 years, the cost base of the employment in IT increased so dramatically that really this one is something you need to keep an eye on, and you really need to focus on things which matters, and work with the resources carefully, because otherwise the cost will just kill you.
Yeah, I fully agree what Peter said. It's exactly like that, and the ability of local markets also to produce enough IT specialists and these guys for the future, for future transformations of these countries as economies. This is something what, if I would be, let's say, the politicians, this should be, let's say, some kind of point of focus, because it's like Peter said, this overheated market, exactly as Peter said.
And Peter, how you keep the independence, considering that this high volatility of the people and high need for the technology development? Can the bank keep the business under personal control, or let's say like that? Or now in case you want to develop the business, then you first need to see what is the possibility of your partners, and then your partners in fact defining what is your business development. What is your situation?
So I think that we used to depend a lot on the external fintechs, and over time it proved to be not sustainable, because you've been slowly becoming in the vendor lock, so-called vendor lock. Yeah. And what we are basically trying to do right now, or not us, we are trying to internalize the IT, so we are trying to hire the experts. But what's right now happening in the market, and the big competitors in the market are trying to do so. In Czech, it's going to be Česká spořitelna, which is part of Erste, or Komerční, which is part of Société Générale. They are establishing their fintech hubs, basically companies which are supporting the fintechs, which are then developing for them. So basically, they are trying to avoid to hire external vendors. They are trying more to invest to companies and basically provide them with capital to do whatever, to do cheaper whatever can be bought on the market. So that's the approach which is right now evolving on the Czech market.
Well, thanks. And
I can also add here experiences. I mean, we are not even in the fintech area so far, but fluctuation in IT divisions of all banks and other financial institutions has risen tremendously in the past period. So it's really, really difficult to keep good IT staff within institutions, and because they also start to build their own companies. So banks are actually increasingly outsourcing even the core areas of business, such as maintenance and reporting and all kinds of stuff to IT providers. So I'm really eager to see and excited to see what the future is going to bring. So it's good to hear that there are tools to this brain drain that is happening. That there is a way to bring these people back to the institutions.
Thanks, Radomir. And from the compliance side, this dependence from fintechs and IT companies, especially in the situation of digital development, this should be the key point or key problem. How you are facing with that? We cannot hear you again. Sorry.
Something is wrong with the device. Can you hear me now?
Yes, it's good now.
Yes, I cannot say that it is an issue, or really an issue. From what I see in the banking sector in Bulgaria, most of the banks, especially the big one, they're building their own fintech companies. Of course, they don't have the resources to build everything in-house, and they have to outsource to transform some of the activities to the fintech companies. So you need to find the balance in a hybrid mode between both of them. And here I think that it is important to have a proper operational risk management, because you need to manage the vendor management risk. You need to see to whom what you're outsourcing, how reliable it is, and always you need to build at least 2 or 3 options for your services. Because if you outsource your core or main activities and something's happened with this fintech company, you are not in a situation to stop your business because you're losing your vendor. You need to switch automatically to somebody else. That is why you need to manage properly the outsourcing risk.
Thanks. And what about artificial intelligence? You know, is this something? Well, we are facing it with in the daily business, in the daily reports, everybody talking about artificial intelligence. So the question is this still something new, or it become usual tool? So we can start with you, and what is the situation in compliance where we are talking about AI?
For me, the artificial intelligence has become a common tool, which is used in the fighting against fraud and money laundering. From my experience, we used artificial intelligence when we built our anti-fraud solution, transaction monitoring system. We rely on the artificial intelligence to analyze the customer behavior.
I'm sorry, Radomir, we can't hear you.
Sorry. Now
it's good.
Yes, sorry, I will repeat the last sentence. I said that we are using artificial intelligence in the fraud prevention area to analyze the customer behavior, the device security. That is how we secured our customer accounts. This tool gives us the confidence that we are giving our best for the customers. From the anti-money laundering point of view, we used artificial intelligence to analyze anti-money laundering scenarios. We were changing the thresholds in our anti-money laundering scenarios in order to improve the efficiency, first of all, to build a better customer journey, not to request so many questions and documents from the customers. What would be the future with the artificial intelligence from the IML perspective? I think that first of all, it will be using advanced algorithms, statistical or machine learning, for customer risk rating, which is a shift from the traditional expert-weighted factor to statistical regression approach. And the other point would be the so famous know your customer process, because currently it's a calendar-driven approach, and you need to go to a behavior score. But here we should not forget something really important, which is the regulatory framework. We cannot build a digital future without mature enough regulators which are thinking in one and the same direction. Unfortunately, from my experience here in Bulgaria, our regulators are not so mature to say it in this way. They still want to see the paper, which is not the future of the digitalization. That is why we need to ensure that we have a proper digital regulators to address these potential challenges. And for me, it should be one of the top focuses on the EU level. They should not let it on a local level to decide how to manage properly the digital future.
Thanks. Thanks. I would like to go to one interesting question, which I think Peter mentioned. We have a situation that, you know, every model in granting process is based on big data, analysis of big data. It is PD, LGD, weighted collateral values, LTV. So there is a lot of calculation on the back, and which are based on big historical databases. And what is important for these algorithms to use and to make the calculation is stability of the data in certain period. And we have a situation that this current COVID crisis, then the situation with Russia and Ukraine. Now we have extreme situation in Turkey regarding the natural disasters. So all these exceptions, they occur frequently in last couple of years, and these exceptions disturbed the models, the stability of models which we are using in everyday business. So the question is, can we rely and how can we trust in the future our models which are so frequently exposed to exceptions? So this is I think maybe to start with Peter, if it's okay.
Yeah. So what we are trying to do, we are trying to adjust the window of the history we are looking at. So it varies again depending on the product, but with the volatile environment, you really need to rely on the data which you believe are not affected or infected by what happened. So we are, for example, trying to develop champion challengers recently, which works with a very short history of the data, and we are trying to measure whether the behavior of the customers which are assessed by this shorter window is the same as with the customers who are assessed with the normal scorecards, which use the big and long history. So I think that really it depends on the approach you want to take, but my experience tells me that the best approach is to sacrifice for a couple of weeks, months, the new volumes, and basically just fine-tune the current model you have and approve only better customers. And aside that, have a champion challenger, which basically works with the shorter period of time, which should be not infected. So this is the approach which we are trying to take. I'm not saying that it's the best one, but on the other hand side, it's better to act fast than to wait and then see that the portfolio is deteriorating.
And I think when we are talking about the big data and the information which comes, how you, what is the procedure or the rules, how you define how to trust the big data? There is, you know, a lot of companies which can provide you with a lot of information about the customer, with a lot of statistical data, etc. But, you know, how you decide to whom you can trust, because any kind of mistake in the data origin will make the big problems. And what is the rule? How you are deciding that this is eligible supplier, we can trust the data which he can give us, and this one we cannot trust this. So of course we know that there is some reputable agency, but there is much more on the market, and we should try to take more from the market, but also to test and to see how to choose the quality.
So if it aims to me this question, then
yes.
well, we are mostly, or we are always trying whenever we are taking in new data, we are always trying to measure the quality against the data we have already internally and with the data which are somehow verified by our processes. But it's true that, you know, we are on the market for 20-25 years, so we have also a lot of data internally, and then it's a bit easier to slowly incorporate the big data which you can obtain from the market. So this is the general approach which we have, and then if we really need something what we don't have internally, we are always trying to have two resources of the data and compare the samples together and make sure that, you know, for example, on the unified basis, we have sufficient quality.
Yeah, so the big advantage is when you are quite long in the market. And
Yeah,
Miroslav, what is the situation with insurances? So regarding the models, underwriting, and then the calculation which are used in the insurance, they are, you know, strongly based on the calculations, because you know, this is the basic of the business, and how you can trust the models in these times when everything changes more or less every day. And what do you do?
Yes, well, so it's let's say, of course, true that this higher volatile environment, let's say, impacts of our models, but still in insurance business, it depends for which products and for which business lines. So, for example, this complicated economical situation, which we are this perfect storm stuff, maybe doesn't have an impact too much on some long-term mortality trends and so on. So I think in general, we have to be a little bit like selective case by case basis, but in general, still, I think that we somehow, the models are still the best what we have to do. So somehow we have to rely on them. But for me, it's now more important to know the limitations of the model and to be also more careful to interpretation, and maybe less rely on some, let's say, central scenario. For example, if I'm talking about some prospective solvency capital modeling and stuff like that. And for me, this, let's say, volatility stuff, it's more to work with some stress test scenarios or to build more, let's say, bigger set of possible scenarios to know what could be the direction in case that situation will deteriorate in this way or in that way. So in principle, I think that, of course, still we are adjusting our models, we are embedding the volatility inside, because my personal background is that I'm a statistician. So statisticians usually doesn't like too much this volatility if you are making this regression analysis. So you don't like it too much, and you like perfect fitting. But this is not the case. But for me, it's also to know the limitations, really to interpret them correctly and to work with scenarios to see what could happen, and don't be hesitated to work also with some extreme scenario. But we cannot give up the models, and for some businesses, like for example life insurance, this perfect storm stuff, it's not impacting.
So you're not working as a Peter to decrease the observation period in order to stabilize the model. You use the model, but then you are developing the parallel scenarios. So what if scenarios, so that you can adapt.
I cannot say like that it works like that, let's say, in all business and our business lines, and generally yes. But of course, if, for example, for some product and for some situation, we see that the past, for example, last 20 years are really not reliable at all. And now there was some, let's say, paradigmatic change, which is totally new. So of course, in this case, it makes sense to forget what was the past and to think how to maybe shorten and how to make it, let's say, more reliable and adjust it to current situation. I don't have like general answer. It's really more case by case basis. And also the volatility, the source of the volatility versus the product and versus the topic, what we are now solving and working on.
And about the big data, you rely more on the internal data, or you are taking externally? How you checking the data if you are taking it externally?
Honestly, in our business, so far we rely mostly on internal data, which is, let's say, fine for us because we don't so far face too much problems like that. And in terms of like external data, so far we are more trying to using some, let's say, public and government registers. This is also maybe something what is important in this general discussion about digitalization. One thing is that customers are digitalizing in the market, but it's very good if also the government and let's say the public sector is going to be more open and more digital. And this is also something which little bit and step by step happens in Czech Republic. So we try to connect ourselves to this more digitalized public registers, and that's it. But Cardiff in Central Europe so far mostly internal data.
Thanks, Elma. And can you share us your view regarding this modeling and the stability of the models?
Well, in our case, data from the market based on default rates and historical credit register are not available. So the only way to build models are actually, rating models are actually usage of own data. So what we do is we use our own data. Other international groups are also using data from other countries, but in our case, it's actually local data. And the big problem, the big challenge that we had was actually the macroeconomic picture, which was very bad in the past few years. But on the other hand, we have had state measures which have prevented clients from going into default. So the way how we managed to solve this problem was actually not to shorten the period for PD calculation, because it is actually defined by the regulator, as we have to use at least 3-year data. So what we did is we actually prolonged the period of calculating the PDs, and we took past periods where the market in general had worse data, had worse credit quality data. So that was the way to overcome that problem. And in general, for modeling, the data quality is of the most importance on the one hand, and how to be sure that the data are fine. Well, we have to do validations, proper validations. Besides initial validations that are done, we also do a so-called quarterly and half-year or yearly validations, which are checking the stability of the model. And so far, we have, despite the very distorted data, we have not had a problem for a certain client, but for some other clients, we did have a problem with data quality. So it is in general, it is very, very important for banks to have a proper risk model management framework, which defines the owners of data and the owners of the models that are used. Besides that, we have to define the significance and the materiality of the model. And based on that, we then decide who is making a decision on model usage and how often the validation is done and what is the role of control function in that regard. So, besides the whole quantitative analysis, it is very, very important to implement very robust risk model management framework that is aimed at reducing the risk from using models.
Thanks. Well, we have just 5 more minutes, so I would have the last question for everybody. So we passed everything in this digitalization about at the beginning, how we are losing the personal contact, what are the problems which we are facing, what is the stability of the data. And now the question is, what will be the future in the finance industry, because we are going everything fully digital, significant involvement of artificial intelligence, everything is based on the rating models, big data, etc. So is there going to be the bankers within the bank, or is there going to be insurance guys within the insurance company? So this is the question for all. So Radomir, maybe can I start with you?
Yes, thank you, Marco. For me, the human interaction and the artificial intelligence will go hand in hand. So we need to use the human interaction and the artificial intelligence in order to build better services, products, and to be more precise in the technology. And I'm sure that not all of the customers will be digital and they would like to have a digital services. So in one moment we could face the situation where the human service will be part of the premium package. Only wealthy customers could pay for the human services. All the other will go to the ChatGPT, artificial intelligence, and to the digital channels.
Thanks. Miroslav, what is your opinion?
Yes, I also somehow believe that still there will be a space for the human being, because I can really imagine that still there is a lot of space for algorithmization of the processes, automatization, artificial intelligence, and all those stuffs. But still, I think that really you need the humans to give you a vision, to show the direction, to put some emotions inside, and to solve some strategic topics, because these are depending also on your appetite, on your preferences, maybe on your feelings, on your visions, on your entrepreneurship spirit. And this is something I honestly believe that some artificial intelligence cannot replace. So for me, perfectly fine if these items are really managing some repeating and routine processes and stuff like that, and that the human being is the one who is bringing really the added value from some, let's say, strategic layer or some managing thing. So I'm optimistic in that. I don't believe that we will end up just with the companies of robots or something like this. Hope
Thanks.
This type, yeah.
Thanks.
Science fiction scenario is not realized.
It's nice to hear that. So, Peter, what is your view?
I think that it really depends on what kind of a bank or institution you want to be. So I think that we will have banks or insurance companies or other fintech or telco companies where it's going to be fully digital. But I believe that those banks will never become universal banks, and they will be always just a small fraction of the market, and that the banks which or insurance companies which want to be universal, they will always have to be, we call it phygital, so have physical presence as well as digital presence, because you will have always people who love to talk with someone on the counter, and who will be able or who will be convincible to take a loan only if someone will offer them coffee and a bit of a chat. So I think that, we cannot avoid the digitalization. I think it's going to be growing, but I think that at least in Czech Republic, we are already at the point where there is not too much space for an improvement in the universal bank space. It's more about the niches, which will be still booming and developing.
Thank you. Alma?
Yeah, definitely. In our region, we will have to have a customized approach and different products built for different generations. Because definitely we have a new generation that will definitely want digital products, but a very, very important part of all financial institutions are also older generations that prefer human contact. So as all other colleagues said, it is going to be a mix. And several years ago, we thought that digital branches would actually replace just normal branches, and that there would be a trend of closing branches, but that actually did not happen yet. So I think in the Balkans especially, it is going to be at least 10 years, time to really have a quicker implementation of digital products.
Thanks. Well, we have one question which we received. So what is the best way to manage and mitigate the transformation risk? So anybody want to raise a hand to give the answer? We talk a lot about the transformation, here. Peter, please.
Yeah, for me, it's not underestimate the skill set of the people you have in place. So if you want to do really good transformation, you really need to hire the experts, and you need to be ready and prepared to pay the price.
Yeah, and I think that if you talk about the transformation, it should start top down from the management, from the corporate culture, from the organization change, and then you start to transform. Then you are talking about the transformation. So this is my view. Anybody else want to add something? Okay. Thank you everybody for participation. It was really pleasure. I heard a lot of interesting things for me. So all the best, and see you in some other panel discussion.
Thank you.
Thank you, Marco.
Bye.
Thank you.
Thank you all. Bye-bye.
Bye.
Bye.
Thank you, everyone.
Bye.
Thank you.
Thank you. Have a nice day. Bye-bye.
So that was the last session of the Risk CEE Summit. On behalf of Connectiva, I would like to say thank you to all speakers for their presentation and discussions and sharing experience, and to all attendees for joining us. Stay tuned for our next event in the Finance CEE network, which is called CEE Expo, Finance CEE Expo, and is scheduled on the 25 May. Follow our page on LinkedIn for more updates on the Expo. With this, I'm closing the summit. Thank you all again for watching. Stay safe and take care. See you all next time.